Welcome to the meeting of the California Housing Financing Agency. Why don't we get started with roll call?
Ms. Avila Frias.
Here.
Mr. Agee for Fiona Ma. Ms. Gallagher. Ms. Gunn for Dr. Imbasciani. Mr. Hunter. Ms. Johnson Hall.
Here.
Mr. Metcalf.
Here.
Mr. Prince.
Here.
Secretary Podesta.
Here.
Ms. Sotelo.
Here.
Mr. Russell.
Present.
Mr. Gunning.
Here.
Ms. Gordon.
Here.
Ms. Onodera.
Here.
And Ms. Patterson.
Here.
Chairman, we have a quorum.
Awesome. Okay, let's move on to approval of the minutes for the January 10th board meeting. Did anyone have any edits or corrections or comments? Can we deem those approved? Great. Item number 3. I just have to say, last week we were in DC for the National Council of State Housing Agencies, and I want to share with the board just how much and how well this team rocked. California, everything seems to be oversized in California. The personalities, the issues, all the above. But under the leadership of our executive director, they clearly know about California, and I think we had a very impactful time, not to mention a good time, but I just want to, thanks to Melissa, thanks to the team, and certainly thanks to Tia. Tia was working the whole time from the moment she got there to the very last day. And I finally said, I don't think you want to go on that midnight tour with Juan Vargas. Tia, that could be a little bit much, but I just want to commend the team and thank everyone for going, and turn it over to you, Tia.
Well, thank you, Mr. Chair. I do think it was a really good visit. I think Ben and I attended several meetings together. HCD, the State Treasurer's Office sent a delegate, and it was a very good meeting. We met with the United States Treasury on some of our bond veterans issues. We met, Ben met on disaster relief. We met with HUD and HUD officials, and so having us all there and having a delegation, we did provide a legislative briefing for California delegation staff. So I do think it was a successful trip, and thank you all, and thank you all to staff that helped make that happen.
Good. With that, why don't we move on and jump right into our business items? I guess Larry's up first. How you feeling, Mr. Flood?
And while Mr. Flood is coming up to give his presentation, I wanted to let the board know that the Smith Affordable Housing Group presented him over this past weekend with a Lifetime Achievement Award in Public Finance. And it's very prestigious, so let's give Mr. Flood a hand for receiving that Lifetime Achievement Award.
Thank you very much for that recognition. Mr. Chair, members of the board, the resolution that we have before you for your approval is for the refinancing of the Monta Vista Apartments, which is an existing portfolio project in Milpitas. And I believe a representative from Bridge, who is the sponsor developer, is here, I believe. Mitch Crispell is here. Ruth Bakili is the loan officer and will present our report on this project.
Good morning. I'm hopeful that we have some slides because it's a very nice project to look at. Oh, we have to press a button? calling the experts.
Okay.
Excellent. Okay, so Monte Vista Apartments is an existing project. It's about 20 years old in Milpitas on South Main Street. It's been in our portfolio for about 20 years. It's on a 15-acre site, 306 units, pretty large family project. It's located within a half mile of a major mall, the Great Mall in Milpitas, and within walking distance from the light rail and the BART, almost completed BART station, near highways 880 and 680. It's just right in the heart of Milpitas and somewhat East Bay area. If you could go down to the next slide. Thanks. It's a beautiful project, large site, and it's located near schools, services, everything that family housing needs to be near. The project is a neighborhood that is mostly apartments and condos, retail, commercial uses. So you've got a very livable, walkable community in this area and very family oriented. The project itself has 3 playgrounds and lots of open space for families. It has a pool, a cabana, a community room that has a workout area. It has meeting spaces, so it's just optimal location and optimal setup for families. The project was built in 1998 and consists of 20 residential buildings that are 2- and 3-story walk-ups. It has 17 garage buildings and the community building as well. All of the units have 1 garage enclosed space and a parking on site. In addition to the pool and cabana and the community building, there are also 7 laundry rooms throughout the project and lots of meeting spaces and barbecue areas. The project has 72 1-bedrooms, 165 2-bedrooms, and 69 3-bedroom units. All units have a dishwasher, refrigerator, garbage disposable, and the heating and cooling is through a PTAC unit. What we're planning on is a substantial rehab for the project of about $45,000 a unit. And the work will be primarily on the exterior of the project to repair structural damage that has accrued over the years to the breezeways, stair landings, decks, and also these areas will be resurfaced. The windows will be replaced and the roofs will be repaired or replaced on an as-needed basis. All the buildings will be repainted and outdoor improvements will consist of upgrading the lighting, restriping parking areas, and doing some plumbing and sewer line repairs. So overall, the repairs are spread throughout the project. On the interiors, on an as-needed basis, some of the units will receive upgrades such as new cabinets, countertops, and painting, but generally all of this kind of work has been done over time as tenants move out. And so the units are in very good shape. The project's been very well maintained. The developer is in the process of completing the construction plans, and bids will be received in early April and permits issued in May for the rehab of the project. This area of Milpitas is a very strong rental area, particularly for families. And the project itself is about almost 98% occupied currently. Properties in the area are fully occupied, especially rental housing projects. They usually have a waiting list. Over the last 3 years, this project has been about 98 to 100% occupied, and current vacancy is about 1.5%. And in this area, market rents are, as you can imagine, fairly high. For a 1-bedroom, they're $2,500. For a 2-bedroom, they're $2,700, and 3 bedrooms are $3,100. So they're quite a bit higher than the subject rents. The subject is, for the affordable units, are about 42 to 53% of the market rents, And for the unrestricted units, they're about 73 to 78% of market. So the tenants are, even in market rate units, there are 96 market rate units, and the rents are still quite a bit below the going rate. The project for the financing of the project, the existing CalHFA loan will be paid off, and U.S. Bank will do a construction loan of 24 months, and during that time, the substantial rehab will take place. At the end of the 24 months, our 40-year permanent loan financed through FFB will pay off the U.S. Bank loan. Right now, the board report shows an interest rate for our loan that's underwritten at an estimated 5.26%. If we lock today, it would be 5.19. Then the interest rate will be, of course, locked 30 days prior to the construction loan closing. And we're offering a loan of 40 years, fully amortized. And in addition to the CalHFA refinancing, the city of Milpitas and the county of Santa Clara are participating. They are forgiving accrued interest of about $4.1 million. They're lowering their interest rate from about 5.5%, 6% down to 3%. And they're also extending the term of their loan for 55 years. So they're really also coming to the table to help this project. The city and the county will also, as well as a developer, will forego net cash flow distributions in order to generate about $6 million, which will be put back into the project from 2017 to the closing of the permanent loan in 2021. So there's the developer, the city, the county, CalHFA are all coming together to really bring about a positive financing transaction. In addition, the affordability will be increased. Our current restrictions are 25% of the units at 50% AMI. We're going to add also 61 more units at 60% AMI and 50 units at 80%. The city and the county will also increase their affordability from 49% up to a total of 65% at 50, 60, 80. So there's truly a mixed income appeal to this project, and 96 of the units will remain at market rate. But again, quite a bit below the going market rate rents. This transaction, oh, sorry, let's show some more pictures. Here I am going on. But you can see it's a very high quality project, but also in the deck areas, you can see some degradation and some of the reasons why the project needs to be upgraded, especially on the exteriors. But overall, the project is in very good shape, and the units, as I walked through them, showed very well. So thank you for moving those pictures forward, because I always forget them. Also, part of this transaction is paying off a short-term loan that was provided by LIF in June of 2018. That loan was closed back then in order to pay off John Hancock, the existing tax credit investor, and that was a $7.7 million payoff to John Hancock. This project also includes not only payoff to the investor, but also a $2 million developer equity to the developer. That $2 million, $1 million of it will be deferred and paid over time, and $1 million of it will be paid during rehab. But we are limiting the amount of payment during rehab to 15% at construction closing, 7.5% at 50% complete, and 27.5% at construction completion, just so that we're sure that there's enough funding going in and remaining in the project during rehab. We also put in a 25% hard cost contingency. And I just learned from the developer that so far with their costing efforts, the budget that we have of $13.6 million for hard cost is holding true. So the borrowing team, the borrower is Milpitas Housing Associates, and Bridge Housing is the developer. The property manager is Bridge Property Management. Developer, property manager have been the same parties for the last 20 years and have really operated this project very well. The architect for the project, who's been out on the job for about 12 months, is Marks Okubo Associates, who really specializes in large project rehab. And Sarman Construction is also a specialized construction company in occupied rehabs. And both parties have been out at the site scoping and really defining what needs to be done out at the project. So we feel very confident about the budget and the progress of the plans, and believe that we're actually quite ready to close the loan and start the work in late April, early May. And with that, I'll open it up to questions.
Before questions, I'd like to just make two quick points. The first one is that this is one of our final FFB projects of the year. Well, and of the program now, that the ability to put new projects into the program has expired. And the second is that the successful completion of this project will bring us a long way toward meeting our fiscal year goals for both volume and revenue.
Yes, thank you. So in scope of work, there's a nice picture of the decks, the exterior decks. Maybe you could roll back a couple. I assume that's part of the work, given the increased attention to the integrity of these kinds of, I presume those were wooden balconies. Is that a significant part of the rehabilitation?
It is. The fascia boards of the decks themselves need to be replaced, and some of the structural members through the fascia boards. Decks need to be resurfaced. The main elements are in the breezeways, and the structural repairs in the breezeways due to some water intrusion and degradation over time. So it's really going to not only help the decks and the structural integrity, but also breezeways, walkways, stairways, so that this project is good to go for the next 30 years.
That's a significant life safety issue, the integrity of those decks. So the reason I ask those is because these are family units, and will those decks be unsecured at any time? I mean, will there be hazards created through the rehabilitation of the exterior decks?
There will not. It's primarily replacing fascia boards, waterproofing behind them, repainting. So it's not a substantial breakdown at all of the decks themselves.
And so was there destructive testing done of the deck? I mean, I'm sorry to harp on this. We've had deaths in the last few years from
It's a very
deck
important
failures.
issue, and destructive testing should always be an element, and it is here. That's why the contractor, the architect have been out on the site for months now and testing and breaking down all the different elements, including windows, including breezeways, so that they're very sure of the extent of the repairs necessary.
Okay, thank you very much for the reassurances.
Just a quick question. Thank you for the information. I really appreciate it. What is the? How do you turn it on?
Let's give it.
Oh, okay. Thank you. How much is the per unit cost of, or the per unit participation that we have for the affordable units that we're restricting? And how does that average with the other program projects that we've invested in?
So could you give me a little more input when you mean participation per unit?
So the $45 million permanent loan, and we're restricting about 100 and, how many units are we restricting?
Golly, you're asking me the hard questions now, so.
Oh, it just, in your report, I think it says something. We're only restricting about 178 of the 306.
That sounds right, but through the partnership with the city, county, CalHFA, it's a total of 65% of the units themselves.
That are being restricted and then the market. And then how does the per unit average out to the other projects that we've done in this program? it seems like such a, large loan.
It is a
For
large
this.
loan, it's a large project, and I don't have the breakdown on a per unit basis, but I can get that to you.
Okay.
The numbers are big, the project is big. And quite honestly, a unit or a project that's 306 units will bring down the per unit cost or value,
Right.
which is a good thing. And so I'd have to get back to you as to the per unit
Okay.
values.
I'm just trying to understand it in the context of the rest of the program and, given that this is one of our last projects that we have that are being, that will be funded under this program, what that means for the program itself and the success of the program. So, yeah, you can just get back to me offline.
Sure.
Thank you.
When we usually do a per unit breakdown, it's usually based on the subsidy amount that we're putting in. And on this particular project, we aren't actually putting in any subsidy. It's our first lien loan, and the subsidy that's being put in is coming from local government. And local government is basically taking their subsidy to bring down the rents and deferring that and extending the affordability and deepening the affordability based on that subsidy. But usually when we provide you with a per unit amount, it's based on the subsidy that we're bringing to the table. And on this particular instance, we're not bringing any additional subsidy.
Where will tenants have to be moved out during the rehabilitation?
No, not at all. With the window replacement, it's a pretty quick one-day job. They'll rope off that area. Most of the tenants are working families, so they'll be out of their unit that day. And when, so the window gets replaced, you button it up, and it's all done in one day. If they have cabinet replacements, countertop, they do the same thing. You do the scope of work you can get done in one day, close that up, and the tenant comes back at night.
Great, thank you.
Any other questions? Great. Seeing that, thank you very much.
Thank you.
Sarah
Prepared to move resolution 1903.
took the words out of my mouth. Thank you, Mr. Russell. Is there a second?
I'll second. I'll second.
Okay, seconded. Seconded.
Seconded.
Roll call, please, Melissa.
Ms. Avila Farias? Mr. Ag?
Aye.
I'm sorry, Mr.
Ag.
Ag, thank you. Ms. Gallagher?
Aye.
Ms. Johnson Hall? Yes. Mr. Metcalf?
Yes.
Mr. Prince? Yes. Secretary Podesta?
Yes.
Ms. Sotelo?
Yes.
Mr. Russell? Aye. Mr. Gunning?
Aye.
Resolution 19-03 is approved.
Thank you.
Still on deck, aren't you?
Yes. We're ready to proceed, Mr. Chairman, the next 5 items on the agenda constitute our annual financing resolutions. The purpose of which is to authorize staff to effectuate the transactions necessary to meet our business plan goals. The first item is for your approval is the single-family bond financing resolution 19-04. This resolution has 3 articles, and I apologize for the fact that that I believe this resolution was a handout as opposed to the one that's in your financing package. There was a last-minute change to one line that I will get to when we talk about Article 3. Article 1 of this resolution just authorizes the issuance and sale of refunding bonds. It prohibits the issuance of variable rate bonds to refund fixed rate bonds. and it authorizes staff to modify and replace existing financial agreements, including hedges, and to provide liquidity and credit enhancement. Article 2 authorizes the issuance of single-family bonds on the tax-exempt side up to the CDLAC cap and up to $100 million in taxable bonds. Article 3 authorizes staff to do all of the activities necessary to effectuate the goals in this indenture and in our business plan, including the payment of cost of issuance with respect to any bonds financed in the single-family area. It also allows us to enter into short-term credit facilities, and the change in the resolution is in this provision. We've added to this provision a change to the definition of short-term facility to include the pooled money investment account. I think that concludes my presentation on for Resolution 19-04.
Any questions?
Questions that just generally that are not just specific to this one, but just the overall financing, the debt financing. You know, in my line of work, we're tuned into the new SEC rules about financial disclosures and continuous disclosures, and I'm just curious as to kind of where we are as a agency on debt management policies and how we're integrating that, and to what extent that it's affecting the agency and disclosure, et cetera.
Well, I mean, we've been tracking all of the changes to in SEC policy and to 15C212 in particular, and have been consulting with both internal legal staff and with bond counsel on exactly what we need to do and what changes we need to make in order to continue in compliance. I guess we've also been looking at the phasing out of LIBOR and trying to figure out how those activities are going to affect the way we do business, and how we need to deal with the fact that we have a number of LIBOR-based swaps that are still outstanding. So all of those things, I think, are part of the current conversation, and I think as we make progress on deciding what changes need to be made to our financing plans in order to comply, we will certainly bring those to you as they occur.
Also, we have from time to time done a board training on and disclosure and reminded the board of its fiduciary duties. Mm-hmm. It's been a couple of years since we've done that, and so we can put that on the agenda to have an update on that.
Yeah, and what in that area, it's, you know, we don't ever see our disclosures, really. It's not something that comes to the board, and so there's a little bit of a gap there in terms of how is that stuff being prepared and vetted, and how are we maintaining that. That would be helpful, I think, to.
Yes, we'll do a board training and a board briefing on that. I think we have an audit meeting coming up, and maybe on the same agenda that we do our audit meeting, we could provide that update.
27.
Yeah. 27th? Mm-hmm. Okay. Staff, let's add that to the agenda.
Any other questions? Is there a motion to adopt Resolution 1905?
I move that we adopt Resolution 1904.
4 or 5?
Which one was
Four.
presented?
4.
5's up on the screen.
Five,
That's
sorry,
what I
5
thought.
is, I think.
You moved ahead of us here, Larry. Yes, 1904. Thank you, Anna Marie. Is there a second?
Second. No, I defer.
It's been moved and seconded. Roll call, please.
Ms. Davila Frias? Mr. Agee?
Yes.
Ms. Gallagher?
Aye.
Ms. Johnson Hall? Mr. Metcalf?
Yes.
Mr. Prince?
Yes.
Secretary Podesta?
Yes.
Ms. Sotelo? Yes. Mr. Russell?
Aye.
Mr. Gunning?
Aye.
Chairman, Resolution 19-04 is approved.
Thank you, Mr. Chairman. Now we move to Resolution 1905, which is essentially our single-family non-bond resolution. It's not particularly different from what we submitted last year. Article 1 authorizes our MBS securitization so that we can continue our very successful TBA program for single-family. Article 2 authorizes up to $2 million for the purchase of first lien whole loans. In support of our single-family agenda, it also authorizes up to $2.5 million for subordinate loans and loans to local partnerships. And the third article, like the previous resolution, just authorizes staff to effectuate the necessary transactions to support the transactions contemplated by this resolution. And that concludes my statement on 19-05.
I'm curious at Article 2, the dollar numbers look relatively small. When do we use those, or how do we use those? What's the order of magnitude we're actually moving that authorization?
I think that, most of it is fairly small. I mean, I think that we use it essentially for warehousing, for, daily purchases of loans before they're securitized. And our turnaround period has gotten so small that we don't really need that much. I think we turn around loans in 24 hours.
I think too, under funding purchasing loans agency funds, that was special programs, specifically a special program I think we had with Caltrans, right? And so that's the lending authority specifically for that.
Recycled capacity.
Yes.
Okay, that makes more sense. Thank you.
Question? Any other questions? Is there a motion to approve resolution 19.5? Moved in second, roll call?
You guys get Fresno on the map, right?
Yeah.
Ms. Avila Farias?
Yes.
Mr. Agee?
Aye.
Thank you. Ms. Gallagher?
Yes.
Ms. Johnson Hall?
Yes.
Mr. Metcalf?
Yes.
Mr. Prince?
Yes.
Secretary Podesta?
Yes.
Ms. Sotelo?
Yes.
Mr. Russell?
Aye.
Mr. Gunning?
Aye.
Resolution 19-05 is approved.
Thank you. Resolution 19-06 is our multifamily bond resolution. This resolution has 4 articles. Article number 1 authorizes the issuance of refunding bonds, including permanent financing of short-term construction period bonds that we do, particularly in our conduit program. Article 2 authorizes the issuance of bonds up to the amount of the SIDLAC cap that we apply for, and up to $250 million of 501c3 and taxable bonds combined. It also limits the amount of conduit refunding bonds that we can issue to $750 million. Article 3 authorizes, that's Article 3 that restricts our conduit issuance up to $750 million. And Article 4 allows us to do a number of things. One, it gives staff the authorization to complete the tasks that we need in order to meet the goals of the resolution. It gives us permission to foreclose on mortgages that are either owned by Cal HFA or are serviced by the agency, and to enter into various credit facilities for interim financing and short-term lending. Of note in this particular resolution is that it's been modernized. There were a number of restrictions contained in this resolution in the past that limited our ability to do variable rate bonds with respect to multifamily. We believe that with our new enhanced procedures, reporting requirements, our enhanced ability to manage our balance sheet, and the addition of a enterprise risk management group, that we now have the tools to responsibly manage that. The second piece is that in order to be competitive with the banks and other JPA issuers who are doing small portions of bond issues to produce a lower interest rate, in order to be competitive with them, that particularly on conduit financings, there may be opportunities for us to be competitive by issuing small amounts of variable rate debt. And I think that concludes my statement for Resolution 19-06.
Mr. Chair?
Yes, go ahead.
In the past, when we issued variable rate debt and the board had limited our ability to issue variable rate debt, that was on the variable rate debt that we had that was most costly to the agency was on the single family side.
Correct.
And so when you're requesting the ability to issue variable rate debt, you're only asking that on the multifamily side. Is that correct? So I wanted to make sure that the board was aware that that is variable rate debt on the multifamily side, and we are not seeking to do variable rate debt on the single family side. The default rate of our multifamily portfolio is less than probably 0.05%, probably less than 0.01%. But we do have, I believe, significant accountability reporting and our processes and procedures that we've worked on for the last 3 years to let the board know what we are loaning on the multifamily side. And this does allow us a tool to provide financing on the multifamily side, which we so desperately need to help with this supply and production of affordable multifamily rental housing.
I guess this question is either for Theo or Larry. Does this help you get the product out there and be more pliable and flexible and attract more developers in terms of this?
We believe so. And as always, those loans would be brought before the board and fully disclosed to the board, and the financing structure of those loans would be brought to the board. But in discussing that with staff and in attending conferences and understanding what the need is in the industry, we do believe this would provide us with additional flexibility to meet those needs.
Okay. And then given that you've spent the last couple of years creating checks and balances, I think, I would certainly be supportive of this. But are there any actions within the resolution itself that differ from the board control that we used to have other than the variable the variable rate issue?
No, that was the additional
That was it.
requirement.
Okay.
That was, was there anything other than the variable
No.
rate date on the multifamily? That was the
Okay.
one new thing to the multifamily resolution.
Thank you.
Any other questions?
I have a really narrow technical one. In section 16, the very end of the first paragraph, where it talks about enabling the agency, terminating in bank bonds. Can someone explain that about the redemption of existing bonds and acquisition of bonds that have been put to liquidity providers as bank bonds? I need a little schooling on that.
Yeah.
What are bank bonds?
I'm going to defer to our Director of Finance.
Yeah, no, what, variable rate bonds that are put, when someone wants to sell a variable rate bond, it's put back to the credit facility provider, and then the remarketing agent remarkets them. If the remarketing agent, for whatever reason, cannot successfully remarket the bonds, they become bank bonds, which means they become, the interest rate on the bond kicks up to what in the documents is the bank bond rate. and that's the rate at which they are held at by the agency. It's usually substantially higher than what the market rate would have been if the bonds had been successfully remarketed. And one of the hindrances of doing a large portion of your balance sheet as variable rate debt is that the rating agencies, in terms of maintaining your rating, would like to see what happens if all of your variable rate bonds go up to the bank bond rate for some period of time. So you try to to manage the possibility of that happening. I mean, there are certain times when you really just can't do anything about it, and that was what happened to us in the financial crisis. But and it's another reason why we've tried to keep the percentage of variable rate debt requiring a liquidity facility very, very low. In fact, I think in our portfolio right now, we only have about 30-some million of variable rate bonds that require a liquidity facility.
Thank you. That's very helpful. Thank you for the illustration. Appreciate it.
And we have multifamily bond counsel out in the audience too.
I see. Any other questions? All right, we'll entertain a motion to approve Resolution 1906.
I move that we approve resolution 1906. Second.
It's been moved and second. Roll call, please.
Ms. Avila Farias,
Yes.
Mr. Ag,
Aye.
Ms. Gallagher,
I think I have to abstain from this one.
Okay.
Noted.
Ms. Johnson Hall,
Yes.
Mr. Metcalf,
Yes.
Mr. Prince,
Yes.
Secretary Podesta,
Yes.
Ms. Sotelo,
Yes.
Mr. Russell,
Aye.
Mr. Gunning.
Aye.
Resolution 19-06 is approved.
Thank you. Resolution 19-07 is our multifamily non-bond financing resolution. Article 1 authorizes lending from external sources such as the FFB program, Federal Home Loan Bank program, et cetera. And it authorizes the use of up to $75 million of money in our HAT account to finance programs consistent with our business plan goals. And there is no Article 2. This is a very short resolution.
Great, thank you, Larry. Any questions from the board? Go ahead, Ellen.
We've had that Article 2 authorization, I think, before, and the question is, that was something we were talking about and watching. How actively have you used that authorization?
The non-bond?
Yeah.
We use it to do all of our FFB deals, and that's been, a very successful program. We are, I guess when we get into the workshop, talk about other sources that we are looking at, both in terms of partnerships and in terms of other warehousing facilities, other than the Federal Home Loan Bank line that we have, that we've pretty much been using to purchase single-family MBS. But we're also looking at facilities to help us warehouse multifamily on a tax-exempt basis so that we can refund them into permanent loans.
Larry, what's our current limit on our Federal Home Loan Bank credit facility?
Our current limit is $200 million, of which we have about 82 or 83 million available in terms of the amount of collateral that we've posted. We could get that amount higher, but we'd have to post a lot more collateral. And we just haven't needed a larger facility than what we have available.
On this resolution, it does
allow for the pledging of a portion of the agency's portfolio, I would assume as part of some securitization of this product. Under our policies, is there a limit to how much that pledge can be? If you know.
I don't believe that there is a specific dollar amount limit. I haven't looked at the policy in a little while, but I don't believe that there's a dollar amount limit. But we have very few things that that we actually post collateral for. We post collateral against our swap positions, and we post collateral against things like the Federal Home Loan Bank credit facility, and both of those are limited by the amount of the facilities that are outstanding.
Mm-hmm. I think that that's something that we might want to think about as
Yes.
an agency.
And so right now, we wouldn't be able to post more than the Federal Home Loan Bank, is what he's saying, it would be limited to 200 million. So right now,
okay.
we're using the single-family mortgage-backed securities as that collateral for our credit line with the Federal Home Loan Bank. There has been discussion about using multifamily portfolio as potential collateral for the credit line we have with the Federal Loan Bank. So the limitation that we're aware of would be the $200 million limitation for that credit facility. And anything more than that, we would bring back to the board. But we will also go back and look at that policy. Now, I see Tim Sue sitting back in the back. Are you aware of a policy that would limit the amount of security that could be pledged on the multifamily side other than the limitation on the actual credit facility itself? Okay, so the limitation that we have would be the 200, and we actually came to the board and got, if you recall, that was originally 100 million, and it was going well, then we came back to the board and asked for 200 million. So if we were going to get a new credit facility or increase that credit facility, we would have to come back to the board for approval. So as we sit here today, the limitation on what we can pledge would be the credit facility limitation itself. Does that make sense?
It does, thank you.
Then can you explain the gap? The 83 million is what you're saying, what we can post now? Is that just given in our inventory of single-family loans? Or why the gap between 83 and 200?
It's based on for every draw that we make on the facility, we have to post collateral against it. And so the 83 million that we have available is based on the value of the collateral that we posted. We can post more and have more money
Okay, so
available.
so
We
it's
just
not
haven't
available
needed-
of collateral to post, it's just what we've so far posted as collateral.
Correct.
Okay,
We've been very judicious.
okay.
I like that.
Second. Any other questions? You ready to second? Yeah. Is there a motion?
I'll make the motion so we can second.
If there's a motion, is there a second?
I'll second.
It's been moved in second. Roll call, please.
Ms. Avila Farias? Yes. Mr. Ag?
Aye.
Ms. Gallagher?
Yes.
Ms. Johnson Hall? Yes. Mr. Metcalf? Yes. Mr. Prince? Secretary Podesta?
Yes.
Ms. Sotelo?
Yes.
Mr. Russell? Mr. Gunning?
Aye.
Resolution 19-07 is approved.
Thank you.
One more, Larry.
The final resolution is Resolution 19-08, and it is our SIDLAC private activity volume cap resolution. This one is fairly simple. I don't think it's much different than what we proposed last year. This resolution authorizes the agency to apply for up to $1 billion of private activity bonds for single-family home ownership and for $2 billion of private activity bond allocation for the multifamily program.
Questions from the board? Go ahead, Ben.
Yeah, just a basic question. So these, this authorization would apply to the constrained amount of volume cap that is identified under federal law that's made available to the California Debt Limit Allocation Committee.
Correct.
And so, is there a risk that, you know, we could, I mean, there is some thought that we might be approaching that cap statewide in the year to come. Is there therefore, I guess, either a need to make sure that we're moving quickly to tie up that volume cap for this authorization, or is there flexibility built in to allow us to release back to the Treasurer's Office cap that we might make a claim for, but might not end up using, such that can be put into play?
Sure. I think that the purpose of this resolution is simply to authorize staff to apply for whatever allocation is deemed necessary up to these limits. At least on the multifamily side, we have a significant amount of carry forward that we've received both in 2017 and 2018. And so we wouldn't actually be applying to SIDLAC for volume cap until we exhausted what we have in carry forward. And then if we applied, it would really only be what we needed to actually do the transactions at the time.
Great, thank you.
Any other questions? Is there a motion?
I'll make a motion.
It's been moved. Is there a second? Second. It's moved and seconded. Melissa, roll call.
Ms. Davila Frias? Yes. Mr. Agee?
Aye.
Ms. Gallagher?
Yes.
Ms. Johnson Hall? Mr. Metcalf? Yes. Mr. Prince? Yes. Secretary Podesta?
Yes.
Ms. Sotelo?
Yes.
Mr. Russell?
Aye.
Mr. Gunning?
Aye.
Resolution 19-08 is approved.
Thank you, and that concludes my report.
It's a long time up there, huh?
Mr. Chair, as we have Don come up to give his mid-year report, I'd like to welcome Kate Gordon, with the Director of the Department of Office of Planning and Research. This is her first board meeting, so thank you, Ms. Gordon, for joining us. And regarding the SIDLAC and the volume cap, we will continue to work with the Treasurer's Office. They have been an excellent partner over the last year. We've always worked in tandem with them when it comes to volume cap, making sure that we have strategies to bring down every dollar that we can, and if there's need to work with them to continue on those strategies, we will continue to do so.
Great, thank you, Tia. I want to draw the board's attention to the regular reports that are included in the packet. Make sure you take a look at that. Before we move to you, Don, let's check if there's any comments from the public. Anyone would like to say anything?
Can I just have a follow-up comment? We talked, I know Larry, you mentioned it a little bit, but that LIBOR switch.
Yes.
There are issues there around that, and I don't know if you can add that to some of the debt management discussion at the next meeting. That and the swap portfolio of the kind of unhedged swaps or the unlinked swaps, just where we are in that, and I think that's worth having a conversation at some point.
And then I just had one question. I noticed on the investment report, are we required to be in the treasurer's pool money account by law? I figured as much. We have to take that low rate, huh?
We have some latitude.
We have some limitations, but don't we have a Bank of America? We have other accounts, but there's, on those accounts that are outside of the PMBIA, there are certain limitations around what they can look like. Exactly.
They have certain collateralization requirements, like 110% collateralized accounts, that type of thing.
Okay, good, thank you. Any other comments? Okay.
Okay.
Let's move on to the fun part, the workshop part.
All right. Good morning, Chair Gunning and members of the board. I'm Don Kavir, the agency's Chief Deputy Director, and today's workshop, you're going to hear from several very distinguished speakers on issues related to California's overall economic outlook, as well as housing policy updates at the state and federal level. However, before we jump into that, staff want to provide you with a mid-year update on CalHFA's 2018-19 business plan and operating budget. Your board packages contain a detailed report outlining the agency's progress on each action item identified in the business plan. So I'm going to try to keep my remarks to the most significant elements of the business plan, including updates on our lending activity and our revised projections for the remainder of the fiscal year. Once I've completed my overview, I'm going to ask my colleagues, our interim director of multifamily, Larry Flood, and our director of homeownership, Tim Su, to provide the board with a deeper dive into the programs and also give you a preview of some of the initiatives that they're contemplating for next year's business plan, which you'll see in upcoming in May. So by way of review, the agency's business plan is made up of 4 overarching goals. First is to increase the agency's future income and equity position by expanding single-family and multifamily lending activities consistent with state housing needs. Secondly, to continue to improve operational efficiencies through the use of technology, workforce planning, and the implementation of best practices. Third, to collaborate with other housing entities and stakeholders to drive effective and innovative housing solutions. And fourth, to help prevent avoidable foreclosures by assisting eligible homeowners through our Keep Your Home California program. With these goals in mind, staff develops strategic strategies and action items to support the achievement of the stated goals, and collectively those become our business plan. Before I get started, I would also like to point out that you all have a copy in your package of the detailed action item business plan with a status bar, if you will, that shows you the percentage complete of each of those action items. The first key strategy in the business plan was to generate income and promote homeownership for low and moderate income families. And I'm proud to report that the agency's single-family lending program is on pace for another record-setting year. Last fiscal year, CalHFA recorded the best year in the history of the organization for single-family lending, securitizing more than $2 billion in first mortgage loan purchases that assisted over 7,600 first-time home buyers. This fiscal year, we're expecting to surpass that record-setting mark by 40%, helping over 10,000 first-time home buyers. At the time the 2018-19 business plan was established, the Federal Reserve had a consistent pattern of every quarter ticking up the federal funds rate. And so as we were building the plan, we were trying to be conservative in terms of what impact that may have on our production. As it turns out, the goal was indeed conservative. We had tagged to do about $1.5 billion and probably serve somewhere in the neighborhood about 5,700 first-time home buyers. But at the mid-year mark, so December 31st, we had actually securitized 5,995 first mortgage loans worth $1.7 billion, or 113% of our business planning goal. And correspondingly, our subordinate lending volume has also outpaced our expectations, and we've purchased $108 million in subordinate loans from our lender partners. While one can never be completely sure of what's driving these volume factors that we're seeing, it's reasonable to conclude that the rise in interest rates have pushed or pulled demand forward on the part of the borrowers who are trying to hedge against potential future interest rate hikes. But we also think it's safe to say that we've also have an expanded menu of loan products, and Tim has, I think, told the board a lot about the different changes that we've made and the new products that we've added to the mix, and the speed at which we are able to execute the transactions has been very well received by the lender partners. So we now turn around a loan decision in hours versus weeks or days when, 3-4 years ago, that was the trend. And so I think that ability to execute has also pulled a lot of activity our way. So,
Don, question for you.
Sure.
Do you think there's a better image of CalHFA in the marketplace now as a result of that? I would think there's a certain level of.
I'll let Tim speak to it. I would say personally, the individuals that I know that work in the single family space, a few of them are our preferred lenders. I think it has diametrically changed. I mean, they used to look at it as more of an impediment or something that they needed to do rather than wanted to do, and I feel like that has shifted. Tim might have a better context in terms of the broader group.
I would say an emphatically yes. When I started on a single family, when I started to head up the single family program about 2.5 years ago, about 3 years ago, Don was speaking to our turnaround time. This is all public. It's on our website. We actually show the lenders how many loans are actually in the pipeline as waiting to be approved. So we update this twice a day. It's very transparent. And when I first got to single family program, we used to have almost 1,000 loans stuck in the pipeline. And we used to beg our staff to do overtime so that we can get these loans approved. We went from that to now basically turning around loans intraday. I think that most of you folks know that the interest rate market has really caused a lot of turmoil in the single-family lending space. There's a lot of lender consolidation. There's a lot of lenders just going out of business. And in the last 2 or 3 months, we're still booking on new lenders. And I think one of the things that we hear about, and this is also true in the secondary market, lenders come and use our programs first. If it works, it's the best program out there for first-time home buyers. And if it doesn't work for us, and I can come back to why it sometimes doesn't work for us, they go to other people. I like to think we're the lender of first resort, not the lender of last resort.
So on that note, I would just point to the chart as well that based on our current pipeline and our historical pull-through rates, we expect to do nearly $3 billion in first-time home buyer lending this fiscal year. And probably about $156 million in subordinate lending associated with that first lien product. The business plan also set forth revenue targets for the single-family program at $19.3 million. At mid-year, fee income generated from single-family lending programs was $20 million, or 104% of goal. And based on our new projections, we believe we'll hit $35.5 million being generated from the single-family program for this fiscal year. Other significant accomplishments of the single-family lending program include implementation of a new Fannie Mae manufactured housing loan product that is a complement to our existing FHA manufactured housing product. Renewal of contracts with providers of financial literacy and homebuyer counseling to continue our efforts to promote sustainable home ownership. Additionally, we've executed an agreement for a pilot ADU program in partnership with a nonprofit development entity and locality. The intent of this pilot program is to establish a proof of concept and refine a program design that is both scalable and replicable throughout the state. Another notable change to the single-family program is the expansion of program eligibility to allow non-first-time home buyers who are victims of disaster, allowing them to access our down payment assistance funds to help them purchase and secure a new home. Single-family programs also eliminated a third-party contract for processing loan reconveyances, and we brought that work in-house. And this change has saved about $360,000 a year, and we just absorbed it with existing staff resources. Another key strategy for the agency was to generate income and increase rental opportunities for low and moderate income families through our multifamily lending programs. Multifamily targeted $415 million in lending activity and $11.9 million in revenue generation for 2018-19. At mid-year, the program's volume and revenues are on track to meet our business planning goals, having closed $92 million in permanent lending, $234 million in conduit issuance, and $6.9 million in special needs housing program loans, bringing our total lending activity to $333 million at the mid-year mark, or 80% of our business plan goal. The multifamily pipeline of transactions set to close prior to the end of the fiscal year gives us confidence that the program is going to exceed our business planning goals, and consequently, we are anticipating that we will close about $621 million in overall lending activity, or about 150% of goal, and that we would meet the individual goals laid out for both the perm lending, conduit, and special needs activities. Additionally, we also anticipate exceeding our goals related to revenue generation as well.
Don, one second.
Yes.
So, talking earlier about pulling in additional deals that we kind of got to bump up here. How sustainable is that? I mean, are we projecting based on sustaining a higher level of activity? If we've just swept from the future into the present, is that really, will the future look as robust?
I think I'll let Larry speak to that too, but personally, I think a lot of the things that we'll be touching on with you during the business plan and even some today in terms of future initiatives, I feel very confident that yes, we will. Much like what you're seeing in our single family program, I think we internally are optimistic you're going to see this kind of liftoff for our multifamily program. We're doing a lot of work around our pricing strategies and the way that we're going to be structuring multifamily transactions going forward. I also think that our pipeline sort of supports where we're going. We'll probably be conservative in our estimates for 1920 as well, because until we have a historical track record of being able to sustain lending volume at a certain level, I have personally no interest in getting in front of you telling you I'm going to do a ton of lending and then come back and try to explain to you why we didn't hit it. So I think we've tried to recalibrate, and I think I'm speaking for Larry a little bit, but I feel like these numbers have been vetted pretty thoroughly by his group in terms of the expectation, because I put a lot of pressure on them to not put out too much optimism and try to be realistic about it. So.
Well, and so actually my comments are probably more pointed at the single family, because what we're seeing, I track regionally, but San Diego, people have reached the capacity. We are actually seeing a leveling off of home sales because people have reached their borrowing capacity. So unless we can see growth in the ability, I mean, if wages shoot up or something, I think we're, at least locally, we're seeing a burst of activity that then fell because there just isn't new capacity. Unlike multifamily, where there is an unlimited, oh, not unlimited, we will struggle to provide for the need that's out there, but could you speak to the single family market?
I think that there is a constant effort on our part, not just to streamline our program, but to add different loan products, to add the analogy that I've been using internally is to continue to add to our menu of offerings. So it is true that I think that overall we share your concern about the affordability, meaning that if people have stagnant wages and prices continue to go up, it's going to hit a point in which people just can't afford it anymore, which is part of, in a strange way, that's part of the reason why our program is relevant, right, is that we're helping people with down payment assistance. I don't have a crystal ball. I can tell you that over the last month or so, and February and March is relatively slow from a seasonality point of view for single-family lending. We're still getting about 50 to 60 loans a day in terms of reservation. And if you count normal 20 days in a month, that's 1,000 loans. That's a lot of loans. So, but that is slower than what we were experiencing, let's say, in fall last year, in which we were routinely getting 70 to 80 loans in a day. I think that we're trying to make sure that we can support those levels of lending, but at the same time, for a good reason, we're not as driven by just pure production. And I'll come back to talk about some of that a little bit. Tia and I and Don talk all the time about, we care about production, yes, but we also care about sustainable homeownership. And I'll come back to talk about that later.
So maybe,
and I think I would just simply add to that. I think a lot of the changes that we've made in the program, and while we can't be sure, but I think we feel that part of what we're seeing is CalHFA taking more market share of what's out there. So when you look at the big pie, we might have been, say, 4% of that pie in prior years. We don't know for sure yet, but I think we suspect that our share of the pie is larger now in terms of that. So for what that's worth.
If I could make just a comment on the multifamily side, I think that we have a number of initiatives that we'll talk about a little bit later. I mean, I think that standing up SB2 and other outreach initiatives are going to really boost our conduit issuance. I think the preservation program that we are actively standing up are going to give a boost to our first lien lending. And I also think that the wind down of our special needs program is going to give a boost to the amount of special needs housing deals that we're going to finance over the next year.
My question was back on single family, and I don't know if I'm jumping ahead in our agenda, but how much of the spike in volume is related to the income caps? Because that's changed in that.
It's funny you mentioned that a lot.
Yeah.
The board, you might recall that at the January board meeting of last year, we increased our single-family income limit to 150% AMI, and also using a household of 8 to size that income limit. It really streamlined our income limit calculation. So I think at that presentation, you might recall that we used to have basically tax-exempt MRB income limit format, meaning that there is a different income limit for different households, starting from 2 all the way to 8. And since we live in a great state of California, we have 50-some states, so we used to have like close to 300 income limits across the state. So the simplification of the income limit, the increase of the income limit has made a big difference in our production. And while we look at this data, I'll present this later on, but we look at this data all the time. We don't believe that we cannot expand the pie. I know that some people are doubtful about things like that in different contexts, but we really feel that we're continuing to serve the population of low income and low AMI, if you want to continue to look at it that way, as we did before. But we really have expanded our pie in our program in terms of serving people of higher income nominally and also higher AMI.
So some other significant updates for multifamily include development of the mixed income program, which was approved by this board back in January and is designated to deploy the SB2 funds from the Building Homes and Jobs Act. The first round of funding awards are anticipated by the end of this fiscal year, so more to come on that. We launched efforts to partner with localities recovering from recent disasters that are at a stage in the recovery process where they can actually benefit from the programs we administer. And we are actively in discussions with Sonoma County at this time and are combing through their pipeline of multifamily developments. And we've had quite a few really good discussions, and I think there's some promising partnerships on that front coming in the near future. Staff further refined the data integrity and timeliness of management reporting for multifamily and asset management through a combination of system enhancements and process improvements designed to strengthen our pipeline management and our portfolio monitoring. Staff developed a quarterly asset management report, which the board saw, where was presented to the board for comments, I think, just before the end of 2018. And we also finalized updates to our asset management program handbook and began collaboration efforts on the governor's executive order regarding state surplus property. And we're working with HCD and DGS with them compiling and filtering those potential properties for future affordable housing development.
Me here. Quick question on the disaster relief efforts in those single-family, multifamily. Are you doing anything to any kind of risk assessment or sort of looking at the projections of future impacts from fire or even from flood or other disasters on some of these areas where you're investing? Is that part of the calculus?
I think whenever a disaster occurs, we immediately go into sort of triage mode with respect to our single-family and multifamily developments that we have within our portfolio and look to see what effects there have been. I know this doesn't quite go to your question on risk assessment, but we do that same exercise for the purposes of trying to identify ways to help. So in the multifamily side, we comb through the portfolio to try to identify properties with vacancies in our portfolio that we could then sort of communicate out to the broader disaster recovery groups to say there's units available for leasing for potential people that have been displaced and things of that nature. But yes, we do look at that. I don't know that we spend a lot of time from a risk assessment standpoint saying we won't lend in this community because we think they don't do a good job with fire, prevention activities.
Well, I'm thinking more just actual physical location. So thinking about Sonoma, for instance, and it goes also to the question of sort of type of development. So I know Santa Rosa is doing a fair amount of work with infill and trying to replan a bit so that ingress and egress is easier, so that it's easier to get out if there's a fire, but also thinking about areas of the county where development is probably not a good idea because of fire risk and increased fire risk. Are you thinking about those types of issues at all as you're looking forward?
Let me, on the single-family side, all of our loans are conforming loans, which means that they have to conform to the requirements of the government-sponsored entities. And what we have noticed is that when the government-sponsored entities, they are doing that risk assessment on the front end, and when they are hesitant to lend in certain areas because of those risks, then we have to comply with that. And so a lot of the risk assessment on the single-family side that you're talking about is occurring through our partners as well, whether that's the master servicer, who is a necessary and essential partner for packaging our loans and selling them on the secondary market, or our GSE partners, which are always performing those risk assessments on a daily basis. They're providing those risk assessments. On the multifamily side, we continue to look at those things. We are actually partnering with Sonoma County and looking to partner with Sonoma County as they're coming back in to address their long-term housing recovery. And we're hoping we can be an essential partner with Sonoma in those respects.
Thank you.
So another key strategy under Goal 1 was to strengthen the agency's financial position by expanding credit facilities and maximizing return on investment and return on equity. To this end, one notable refinement to our single-family delivery model is the ability for us to bifurcate or stratify our single-family lending production into pools of loans that meet certain characteristics that are desirable to prospective buyers of mortgage-backed securities. This expands the marketability of the MBS pools and has the potential of adding value to the securities we deliver to the secondary market. We haven't actually executed that. We haven't seen that benefit, but we've done the work to create that infrastructure because we have had a lot of interest in localities and others who've been interested in purchasing pools of loans that meet certain criteria. And so we're hoping that on the marginal or incrementally, it will add some value to the MBS. Additionally, we've diversified the capital resources available to support multifamily lending. And you heard them talk a little bit earlier about the credit facility with the Federal Home Loan Bank. And basically what we've done is we've expanded sort of the permissive uses of the money beyond just single family. The collateral component, as I understand it, is still limited to posting collateral of mortgage-backed securities that we own on the single family side. But we're working to maybe expand that as well. But in essence, before it could only be used on more of the single family space, and now it's more of a broad credit facility that can be used from a cash flow standpoint. And so for us, it could then serve as a warehouse for multifamily should we need that. Right now we don't, but it's nice to know that you have the flexibility to do that. Let's see. We are now also down, and I think Larry mentioned it. I'm going to make one small correction to what Larry had said earlier, which is that our VRDO balances are actually down to $40.5 million. He's being really optimistic at 30. So they're at $40.5 million, down from the $3.5 billion that we had.
Say that again, Don.
$3.5 billion.
And what do we have now?
40.5 million in VRDOs. And we were able to, again, renew our letters of credit with our three financial institutions. And I think we hope to have that either paid down or gone, unless Larry adds to it with his new ability to do some VRDOs.
Actually, we have a call coming.
And another one of the many changes that we've made to improve customer satisfaction in our single-family program that we believe has helped increase subscription to the program was a change that we do from the funding process for buying our subordinate loans from our lender partners. Basically, we've expedited that and turned that around where we're purchasing a couple of times a week, and that has really made our lender partners very excited because it improves their cash flow and it reduces the cost they have for their warehouse lines. And so I think that has also been a big draw because we're turning things really quickly in terms of the overall execution. Okay, finally, our continuous efforts to improve the financial position of the agency resulted in another ratings upgrade. This time it was from S&P, which upgraded College FA's overall credit rating from A positive outlook to A plus positive outlook, and upgraded our single-family bond indenture from AA minus positive outlook to AA stable outlook. And so I think that's worth celebrating. The next two slides are simply sort of the histrionics of our ratings over the last decade. And as you can see, we're definitely have been on the rebound for a time now.
That green is very pretty, isn't it?
Green is very pretty.
And while I love Moody's, they're a little slow on the uptake.
Slow on the
That's all I'm saying.
It's history, not histrionics.
Okay, let's see where we are here. Okay, on key strategy under goal 2, which is to increase operational efficiencies through the use of technology, workforce planning, and the implementation of best practices. To this end, staff have continued to develop new electronic workflows to replace manual processes throughout the agency. Most recently, we launched a new electronic review and approval process for our board reports. And additionally, we have completed phase 3 of our financial system upgrade, which among other things is automating invoice processing and will eventually provide electronic copies of support documents embedded into the transactions in the system, which is gonna, save all kinds of sort of manual processes and storage processes to begin with. Another example of our efforts to improve overall program delivery and data analytics is the completion of our website redesign that includes mobile accessibility and the initial implementation of a geographic information system for data mapping. On the workforce planning front, the agency has filled key vacancies for General Counsel, Director of Legislation, and Director of Business and Governmental Affairs. Additionally, we are conducting interviews for our Director of Multifamily Programs, and we're starting the recruitment for the Deputy Director in Multifamily as well.
Do we have a College FA app? Or is it just the mobile website?
It's just the mobile
So
website
we don't
when you
have
go
it.
to it. Let's see. And then lastly, on the best practices front, we're pursuing our second award for excellence in financial reporting from the Government Finance Officers Association for the 2017-18 fiscal year for both the comprehensive annual financial report as well as our popular annual financial report.
No, second time.
Second, yes.
Right.
Another strategy under goal 2 is to implement long-term strategies to monitor and mitigate enterprise risks. At mid-year, the agency had completed its reporting requirements under the State Leadership Accountability Act, which requires staff to identify enterprise level risks and ensure that the appropriate controls are in place to mitigate those risks. We also reassessed and updated our insurance coverage requirements for vendors that work with College FA. And completed a business continuity plan simulation to test our ability to get the agency back online after a disaster. We performed a network firewall upgrade and received a third-party validation that our service organization controls are well-designed and operating effectively. This is both an industry standard and best practice that many companies require in order to do business with College FA. You may or may not have heard of it referenced as SOC Type 1 attestation. Don't ask me what all that means other than service organization controls for the SOC part. And lastly, we've instituted continuous and mandatory information security curriculum for all of our staff that is done every other month by our diligent interim director of IT, who requires us all to take information security classes continuously, all year long, every year.
I have to just add this. Mr. Kumar is very serious about IT security and will walk to your office when you haven't done your training and look at you. It doesn't matter who you are in the agency, he will walk by your office and look at you and then look at his watch.
He's looking at you for not taking the training. He's looking at me because I've gotten caught on 2 phishing scams.
So he
Well, no, internal ones he's conducting, not real ones. But yeah, he always gets me when I'm traveling on the phone, right? And I'm always clicking through the emails, and boom, I get trapped every time. So
my accounting staff received an email asking to change my banking account while I was on vacation, and they didn't. I went to someone else.
Oh no!
I think it's great.
Mine wasn't that
Don't stare
bad.
at them a lot.
Yes.
It's not just paychecks, it's a lot of stuff.
Yes, I'm very pleased with our IT security.
Yes.
I know,
Yes.
I couldn't believe it.
So we're getting close. So under goal 3, CalHFA continues to work collaboratively with our state and federal housing partners, as well as other housing entities and stakeholders to promote affordable housing solutions in California. We participate in the Veterans Housing and Homeless Prevention Program. We administer the HUD Section 811 Rental Assistance Program, and we have a seat on HCD's Internal Loan Committee. CalHFA also serves on the board of the California Debt Limitation Allocation Committee, the Tax Credit Allocation Committee, and the Homeless Coordinating and Financing Council. Further, many members of our team sit on several advisory committees for financial institutions, Fannie Mae, NCSHA, among others. Let's see. And regarding the agency's efforts to maximize the use of our Keep Your Home California Hardest Hit funds, the agency is proud to report that as of 12/31/2018, the program has achieved 100% utilization and assisted 79,801 families avoid foreclosure. The program operations have moved to Sacramento from Riverside. And we're expecting things to close down and the final payments to be made sometime either at the end of this year, this calendar year, or the first quarter of 2020. So that concludes my overview on the business plan. Is there any questions before I go into the budget update?
Good job, Don.
So let's see. So,
Hang on a second.
oh, yeah, sure.
Mr. Agee.
Yeah, I apologize. I'm going to have to run. The treasurer's pulling my coattail. We're going to be taking a car ride to the Bay Area here briefly, but I just want to make quick remarks on her behalf. I just want to thank the executive director and CalHFA for their leadership on this issue. While we're having conversations about affordable housing in the state, we've done various things as it relates to rents. I think that the only way we're really going to change communities and ensure there's no displacement is through ownership. And so we truly appreciate the effort on whatever we can do to be supportive. We look to do so and just appreciate working with you all. So thank you.
Thank you, Mr. Agee. And one of the things that we're going to be looking at for the next business plan coming out is looking at coordinating our application process specifically with the Treasurer's Office. And so we're looking for further ways in which we can collaborate. So we do appreciate the partnership. So thank you.
Thank you.
Okay, so moving on to the mid-year budget update. At the same time, you guys approve the business plan. You're also approving our agency expenditure plan to achieve what's laid out in the business plan. And the approved operating budget represents both the resources and expenditure plan for the year and includes expected resource budget of $71.9 million and an expenditure budget of $39.7 million. Go here. So resources are trending about $12.6 million or 35% higher than originally anticipated at mid-year, primarily due to the increased fee income from our single-family loan production and unanticipated multifamily prepayments and their associated yield maintenance payments. The release of insurance reserves that you see up there, I think it's the second line on the resource side. And the increase in loan repayments are the direct result of higher than expected prepayment speeds on the remaining whole loan portfolio. So as those get paid off, we've seen a little bit of an uptick there. The operating budget is trending about $2 million or about 10% under budget at mid-year, due primarily to salary and benefit savings from vacancies and cost savings from reductions in the use of consulting and professional service contracts. As of December 2018, the agency had approximately 38 vacant positions with 16 recruitments at various stages of the hiring process. And while we anticipate that a few of those vacant positions may be eliminated in our upcoming 2019-20 budget process, we intend to balance any position reductions with the long-term needs of the organization. We're always evaluating that. And overall, the operating budget is projected to be $36.8 million, well within the approved fiscal year budget of $39.7. So that was short and sweet, but that is my update on the budget. Are there any questions related to that?
Any questions? Okay. So we're going to turn it over to the workshop.
So what we're going to do is we're going to have Tim is going to do a little bit of a deeper dive into single family, and then Larry will do a little deeper dive into multifamily, and then we will get into our presenters.
And I think we're going to try to break for lunch at noon. Okay, so we're going to power through as much as we can, and then we'll break for lunch at noon.
I promise to finish by noon. I'm gonna look at this presentation. The lens of this presentation is a little bit different from Don's lens. I did the same thing last year. I think it went relatively well. Don's presentation is mostly about production and revenue. I'm going to talk a little bit more about some of the drivers for our program. Why did we do homeownership? Who do we serve? Where are our borrowers? And why do they come to us? I sort of alluded to this earlier, that I like to think that in terms of first-time home buyers, we are the premier program. I think you guys know that we are not a direct lender. We are the premier program for the lenders to use for qualifying borrowers. So the value add and why they come to us is also really important. And I'll end this presentation with some high-level recap of some of the things that we've done in terms of initiatives, some of which Don talked about, and a bit of a preview on what we are thinking about for next fiscal year as well. So in 2018, this presentation, as I mentioned, is based on the origination numbers for the calendar year 2018, which is a slightly different view from Don's view, which is the 6 months of the fiscal year, which is the second half of 2018. So in 2018, we helped 9,912 families achieve the dream of homeownership. We're really, really proud of this number, so I'm going to say that again, 9,912 families. Year over year, we do comparisons year over year, calendar year over year, sometimes fiscal year over year. So in terms of calendar year, year over year, that's 3,024 more loans than we did in calendar year 2017. And if you look at what that translates into in terms of loan dollar amount, that's nearly $1 billion. That's $957 million more in loans that we did in calendar year 2018 than 2017. A couple of things to point out on this chart. Conventional, you can see that we did about 3,600, well, since each of these numbers represent a family, let's not skip out on this. 3,603 loans in the conventional space. That represents roughly 36% of our overall production. That number is an increase from last year by about 10%. Doing more conventional loans is a priority that we talk about all the time with Tia and Don, because we do believe that on balance that the conventional loan product is a better product than the FHA product. Just as a quick reminder, the conventional loan, once you achieve 80% LTV, you could cancel it, whereas FHA a number of years ago made it so that you cannot cancel the insurance over the life of the loan. Another, something that I didn't put on here because we don't have the actual numbers yet. Last year, we achieved about nearly 4% market share in the first-time home buyer space. We don't have the final numbers of the total first-time homebuyer transactions in the state for last calendar year yet, but we suspect that we got closer to 5% of the overall first-time homebuyer market last calendar year. So that suggests that with our loans being close to 10,000, about 5%, that the overall marketplace for first-time home buyers last calendar year was about 200,000 transactions. So on the margin, while we can, what we are trying to do is to continue to be relevant, to innovate on the margin, to add things onto our menu of product offerings so that we can expand our market share and continue to be relevant and serve the first-time home buyer space. Oh, the one other thing worth mentioning is that I mentioned earlier that the refi market is quite slow because rates have gone up, which makes the purchase market more relevant than ever for many of the lenders out there. And as I mentioned last year, about 50 to 60% of the purchase market is actually first-time home buyers. So in a strange way, as rates gone up and as the refi market has fallen away, our program is actually more pertinent and more relevant to our lenders than ever before. So why homeownership? I know that there has been a lot of conversation at the state level talking about mixed income housing for multifamily, and we're totally okay with that. But we like to think that we're quietly serving low and moderate income families through homeownership as well, one loan at a time. If you look at this income band here, about 13% of our borrowers in 2018 actually made less than $50,000. And if you sort of creep up a little bit, you can see that 75% of our borrowers actually made less than $100,000. As Eileen mentioned earlier, we did change our income limit last year, and it hasn't made a big difference in terms of the incremental production in our program. So we're looking at this a little bit differently now. When we compare these income bands to the statewide income, and the latest that we found is 2017, we still see that about 53% of our borrowers make less than $82K. $82K was the statewide median income for 2017. And if you think about this, slightly differently and looking at 150% of that 52K, which gives you about 123K, about 93% of our borrowers still make less than 150% of the statewide median income. So we think that this is the different product for people who are ready for homeownership. And we'll talk a little bit later too about the things that we do to ensure that we're promoting sustainability. But we think that this is a program that's very worth supporting. And who are our borrowers? And I know that this is a chart that Tina usually looked at the chart and she can't believe what we do, but we're happy to support these data that we produce. We are very proud that our programs are reflecting the diversity of the state. About 55% of our borrowers are Hispanics, and about 9% of our borrowers are African American. Both of these percentages they are higher than the statewide demographic percentages. So for the Hispanics, that is about 16% higher than the statewide demographic averages. And for the African Americans, that's about 3.5% higher than the statewide percentage. And you might ask why that is. One, I think that we do a good job of reaching out to lenders who are relevant in those communities. When we talk about reaching out to, let's say, certain lenders who may have a certain customer base in certain communities, this is something that we work on throughout a year. So that's a little bit of pat on the back, but there are, of course, larger forces at play which actually make these numbers what they are. And that is that we generally think that the Hispanics and African Americans population are generally underrepresented in terms of homeownership. And as you know, we are a first-time homebuyer program. So for them to have an outsized representation in our program, it does make some sense. And whereas the white and Asian populations, they tend to have a disproportionate representation in the refi market. So those are the wider sort of market forces that kind of contribute to these numbers. But we're very proud of these numbers.
They're just phenomenal, and every time I see them, part of me wants to cry and part of me wants to celebrate, because these numbers are just phenomenal. So please continue to do the good work that you're doing in this area, because this is an area across the state of California, across the nation, that banks, I know that many of my banker friends would love to have, and they just can't get there.
So where are our borrowers? Most of our productions come from, we don't do a lot of lending in the high cost areas like the Bay Area, and let's say we do some lending in San Diego, but mostly they tend to be condos. The 4 counties that you see here represent about 50% or half of our production. There are still pockets of affordability here. Just to put this in context, although I don't have a slide on this, that our average loan size is still about $280,000. Sometimes it creeps up on the conventional side to about 300 and change. But when you compare that to some of the headline numbers that you hear on the radio or on the news, it's way lower than what you're hearing out there. So it is not the coastal areas, although when we increase our income limits, we are more relevant in some of the high cost areas. So for example, Alameda, our income limit now is 192. But having said that, there's other issues there. There's inventory and other issues at play. So last but not least is that why Cal HFA? Why do people come to us? So before I talk about our value add, this is something that I talked about earlier, that sustainable homeownership is really important to us. We, as some of you actually, as I look around, we don't have any board members today who was here during the depth of the financial crisis other than Mr. Michael. And Michael will remember that we were really, really hard hit. If you look back on the histrionics, the histrionics, that chart.
It's a real word.
It is a real word, but just a couple more letters and it's different from history. So if you remember that chart, we were hit really hard on the single family side when we retained the real estate risk on the single family lending. And I think the board recalls that as much lending as we're doing now on single family, we don't have the same kind of real estate risk on a single family as we once did. These are all conforming loans. They get securitized, they get sold into the secondary market. We learned from that, and we have put in place what the industry calls overlays, meaning that these are things that we require that are required above and beyond what the GSEs require, what the Fannie Mae's or the, let's say, Ginnie Mae's or FHA the world require. So we require home buyer education and counseling. We do require a 1-year home warranty protection plan. Again, we're serving a population that do not have a lot of money saved up in a bank account. That's why they're coming to us for down payment assistance. And then we also have overlay in terms of underwriting. We do not permit a DTI or debt to income ratio higher than 45%, whereas FHA does let it flow up beyond 50% sometimes, and it is a source of concern for FHA these days. And we do require minimum FICO score of 640. And these are some of the key things that we put in place to promote sustainability. And actually, a couple of weeks ago, I got an email from Don, and there was an email circulated by a lender that was comparing how our program was difficult to use and how their program was easy to use. And many of these things that we put in place to promote sustainability shows up. And I looked at an email, I said, I'm not worried. If they want to go out there and make loans that are lower FICO score, higher DTI, they don't want to require a warranty, they don't want to require education and counseling. What does Tia say? Peace out to them. They can do that.
I think it's peace unto you.
They can do that, but that's not what we're about. And I think that sort of harks back to the question that we were talking about earlier, that we are comfortable with the level of production that we have. We're continuing to expand our menu and take more market share, but we're not doing this at the expense of many of these things that we have put in place to promote sustainability. So why do the borrowers come to us? As much as I like to think that these things matter to the borrowers, oftentimes the borrowers are not coming to us because we are advocates of sustainable homeownership. They're coming to us because they found a home and they want to buy a home. And I respect that. They come to us because we have primarily 3 value propositions that are very attractive. One is that we allow a higher CLTV than what otherwise could be permitted from their lenders. And we also don't have a loan level pricing adjustment or short LLPA on our conventional side. So if they get a conventional loan that's high LTV in the marketplace, they could be assessed 1.5 to 2 point. Again, it's called LLPA, so that's fee they have to pony up front. And we administer the state's statewide down payment assistance program. And these 3 things coming together is extremely powerful incentives for the lenders to use our programs. So how can the state of California support all these wonderful things that we're doing in homeownership at CalHFA? As the board knows, last year we attained a permanent ongoing source for multifamily mixed income. We support a permanent ongoing source for down payment assistance at the state level. And this other bullet here, this is an idea that we are working on. So it's true that last year we did nearly 10,000 loans. As we look at that data, however, we see that only about 5% of that 10,000 loans were used to purchase newly constructed homes. So as you all know, there is a focus, I think, from the governor's office and also from the various stakeholders at the state level to really focus on production and supply in the coming years. So one of the things that we're thinking about is that how can we be more relevant in the single-family new construction space? And this plays to sort of the idea of, how do we continually sort of innovate on the margin to continue to offer more things so that we can take on more market share. And our program right now is primarily a 60-day lock program, which plays well in the existing resale home market. But if you're building a new home, or if you're a builder that's building a community, that really doesn't play as well. So we think that in order for us to be relevant in that space, we need to offer at least a 180-day lock for individuals, for example, someone who is recovering from a disaster, or perhaps even like a 360-day lock for a builder who is about to put shovel in the ground. So our idea here is perhaps working with the state for funding so that we can subsidize the cost of this forward rate lock to go out longer. And it's something that we just started bantering about, and I think that last week when we were in DC, we talked to Fannie Mae about this idea, and they really liked it in the sense that they, on their side, also have a mandate for new, more supply and new construction. And one of the sort of analogies that people were using at last week's conference was that affordable housing is like a layer cake. It's like a tiramisu or like a lasagna. That every layer in of itself may not be what drives production, but it's the layers coming together to make that delicious tiramisu, right? To make it all work, right?
Making you
And
hungry?
that, sorry, it is lunchtime. Sorry, I need to stop that.
So much better than sports analogies.
Oh, okay. The food analogy works better in the sports. Okay. So this is an idea we're very excited about, and basically what Fannie Mae said is that if we do something like this, they too can figure out a way to contribute a layer to this tiramisu. So this is something that we're working on. This is a sort of second idea.
If I may, that's a really great idea in terms of providing developers with an option to finance on the back end. Their product, it's huge. They'll be able to do so much more with it. A couple considerations though, in terms of just being able to offset and have a commitment from them to create affordability as part of their, program, and making sure that, for the commitment on the back end, you also get a commitment of affordability on the front end. I don't know what that looks like or what that feels like, but, maybe that's one of the considerations. But I love the idea. I think Cal Home used to have something like this, and it really helped finance a lot of product back in the late 90s. Yeah.
We are very excited about this too.
Yeah.
So as I mentioned, just some high-level recap of some of the initiatives that we accomplished in this fiscal year. Don mentioned manufactured housing. This is, as the board knows, this is an issue that some people feel very passionate about, and we definitely feel that we have a solution here. On the conventional side, we launched our program back in October 2018. We've done about 15 of these loans now, and on the FHA side, we launched it in October of 2017, and we've done about 210 loans now. I won't go through every one of these. I just want to touch on one that is sort of dear to my heart. There's this second bullet here, Fannie Mae 3.2 data upload, and this is as transparent as what Don was talking about earlier about the security compliance. What this is, though, is that for many years, our lenders, and this goes to sort of some of the question earlier about, are we now a program that people want to use? So for many years, we ask, when people come in and reserve a loan on our system, they basically have to retype in many of the data that already exists on their system. And as we all know, when you retype things, you make a lot of mistakes, which leads to suspense. So it creates this sort of terrible cycle of bad things happen, right? So what this is that Fannie Mae has a data template format that is used industry-wide. What we did was that we made it so that people can use that data format to upload data onto our system. So then we reduce the data entry in terms of reservation and lock from something like 50 to 60 data fields down to like a dozen or 2 dozen data fields. One of the things that we talked about a lot, maybe a year or so ago, is that how do we make our system not to be an island on itself? Meaning that we're out there, can all communicate, and all of a sudden, when they come to our world, they have to retype everything over again. This is one of those things that we did to create that virtuous cycle in which if they don't have to enter as much data, that means that fewer mistakes are made, fewer suspense, faster approval, and faster closing. The one other thing I'll mention on here is the tribal Indian reservation lending. We're in the middle of getting comments from the tribe through Cal Rural. We're hoping that those comments will come soon, and we can launch that program in the summertime. And a preview on some of the things that we're thinking about for next fiscal year on 19 and 20. On the topic of menu expansion, we do have the ability to add USDA later this year. We do believe that some of the lenders, some of the borrowers that could avail themselves using the USDA loan product, they're probably coming to us using FHA loan product now. But having said that, we'll add that loan product later this year. The Fannie Mae home style renovation, the board might recall that back in February last year, 2018, we added something called FHA 203K. So what that is that you can get a small home improvement loan when you purchase your home, so that you can purchase something that needs some work, and then FHA will add a home improvement loan so you could have a little bit more money to renovate a home. We'll add the same kind of home improvement loan at purchase on the Fannie Mae side later this year. And the GSE's duty to serve, as the board knows, this is a big thing that the GSEs are working on all the time. Last year, when Fannie Mae opened up their manufactured housing lending under their duty to serve, they announced it in August, and later in August, we announced our program adding the Fannie Mae manufactured housing program. We monitor progress on their duty to serve all the time, and we try to add whatever it is that they can offer as soon as we can. And last but not least is this idea of figuring out a way to make the long-term rate lock on the new construction side a little bit more affordable for both, let's say, someone who is an individual borrower who is building their homes in the aftermath of a disaster, or let's say a builder. Speaking of disaster, I failed to mention that though we did announce the disaster, so one of the things that the board did back in March of last year was that we asked the board to permit our programs to be open to non-first-time home buyers if they were a disaster victim. We announced that in June, but I think that there are a lot of reasons for this, but we really have not made any loans under that program. And I think this is one of those missing pieces, in a sense that a lot of people who are suffering, who suffer from fires, for example, they could be thinking rebuild. And if they're thinking rebuild, our loans products don't really work, right? Because it needs to be closed in 60 days. So we do feel like this is sort of one of those things that could, on the margin, make our overall layers make sense in that particular kind of situation. So we're excited about it as well.
Mr. Chairman, I'd like to request that we break now for restrooms and for lunch. And I invite all the board members, as well as everyone who's here in the audience today. We will be having lunch in the Truckee River Room. It's in the mezzanine level, which is at the end of the hall. If you walk down straight back past the front entrance, you can take the staircase up. And we'd like to return about 1 o'clock, and we can pick up with Larry.
Listen, Larry, can you finish the next 15, or do you want to, what do you think?
I can be quicker than that.
All right.
Can we just power through? I know all that tiramisu's got me hungry too. Larry's right there, and if we can get through, that way we can break and then have the presentations afterwards. Awesome.
Thank you.
Thank you.
A little early, so I would love to just say something briefly from the governor's office before.
Yes, please, hey, go ahead.
But go ahead, and then I can.
Yes.
Well, I guess in terms of the multifamily division, Don did a great job of presenting the numbers. I'd like to talk a little bit about the feel of the group. When I took over multifamily division about 7 months ago, there was a real sort of morale issue, and I think part of that was because of the comparisons to single family. You know, every year after year, single family was knocking the ball out of the park and exceeding their goals, and multifamily was having to explain why they were not meeting expectations. And I think that was created a real morale problem. I think that what's been interesting about the last 7 months is that we've really, as Don pointed out in his talk, made a lot of changes both through processes, procedures, pricing, and approach to other forms of business that have really served to turn the division around. And I think that the growing success that we're starting to feel really has two pieces. I think the first piece is that the changes that were brought about, even though they were tough, were done by the entire leadership team. It was Tia and Don's vision, but the entire leadership team, from Tim and Claire and Mark and Jeree and Rose and Steve Gallagher. I mean, everybody had a hand in this turnaround. And I think that was really important from, an agency leadership standpoint. And I think the second piece of it is that nothing kind of breeds, good feeling and morale like success. And the fact that the multifamily group can now look at goals and see that, we are already well past 50% of our goals for this year across the board, and that we will, by the end of the fiscal year, based on our pipeline, exceed all of our numbers is a big thing. And you can see the difference. You can see that people are starting to engage and that there's a sense of pride coming back to the multifamily division. And I think that's, it's exciting to see, and it's even more exciting to be a part of. These revenue charts are more just a chance for more gloating. I mean, it's really nice to be able to see, these numbers that at mid-year we are, 62% of the way in volume and 72% of the way with respect to revenue. In terms of our achievements, Don talked about the mixed income program. We are also looking forward to the governor's budget and whether or not we get the additional money for mixed income will make a huge difference in our SB2 program, and we're going to have to gear up to figure out how we're going to use the extra money. But that will also help our conduit numbers going forward in terms of volume and revenue. We have greatly improved our reporting systems that we use internally, both in terms of NLS and in terms of what we use for asset management. All of that has been completely revamped, and some of the reports have been shown to the board, like the new asset management report and the new multifamily dashboard reports, I think are extremely helpful to management as opposed to the sort of ad hoc reporting that we used to have. We'll talk a little bit later in terms of our efforts about preservation and how we are getting a lot better at mining our portfolio for opportunities for projects that need to be refinanced in our existing portfolio, and how we're looking at preservation opportunities outside of our existing portfolio. I think the last thing that, while it's not an important thing to the outside world in terms of the people who actually do loan administration and underwriting, being able to marry our financial analysis tool with our reporting software and have them populate in both directions has been an amazing time saver and an amazing, improvement to the efficiency of the way we process information and transactions. The policy initiatives that we've been pursuing this year and into 2019-20 are, as we've said, the mixed income program, portfolio preservation. We have completely revamped our pricing policy, which I will get into. We've updated and added some new loan products that we think will help make us more competitive with the banks and the JPAs. And we've started thinking a lot more about succession planning, which is probably a bigger deal for us than for a lot of other agencies in terms of, just the number of people that we have at Cal HFA who have been here for a long time, and the need to start bringing other people on board to begin to learn and train to fill those positions as those employees retire. The mixed income program, again, we've talked some about, so I can go fairly quickly through this. Don's mentioned that that the program is now accepting allocations of applications. We have 9 lenders who have been approved as preferred lenders. 6 of them are mostly big banks who were approved to do construction and permanent financing. And we have 3 preferred lenders who are doing permanent financing only. The application period's open until April 30th, so we will certainly be coming back to you at a later date to figure out how successfully we were able to move the money and whether or not or how much the program is oversubscribed. We are currently talking to a bunch of developers. There seems to be a lot of outside interest in terms of people asking about how the deals are structured. People are asking for pricing quotes. People are calling on a daily basis, asking questions about the whole application process. So, we feel pretty good that that the outcome is going to be that we have a well-subscribed program. In terms of portfolio preservation, that's been a big area of focus for us. In the past, our preservation strategy was to wait until a developer applied for a permission to prepay and ask for a yield maintenance quote. And that's been fairly successful because we get a lot of those requests. What we've done, though, is put together a review team that consists of members from asset management, lending, legal, and financing to sit down and come up with a strategy for what kinds of deals we want to go after. We've got a number of deals where the loan's going to mature in the next 5 years, where the regulatory agreement's going to expire in the next 5 years. And there are a number of tax credit and other types of deals that are very close to hitting the 15-year permanent loan phase, where they are sort of ripe for refinancing and recapitalization and for paying off the tax credit investors and resyndicating. So we are targeting all of those programs. And, part of what the review team is doing is we'll look at the developer, we'll look at the project, we'll look at their track record with us, we'll look at the size of the deal and whether they want to use us as a permanent lender, a conduit bond issuer, or whether they just want to pay a yield maintenance fee and walk away. All of that goes into the calculus as to whether we want to chase that deal or not. And if we decide we want to chase it, asset management is generally making the first inquiry because they have the existing contacts with the developer sponsors. And if there is traction, then that relationship is turned over to a loan officer. And we estimate that we probably have about 200 projects in our existing portfolio that are close to that 15-year maturity window that we can try to refinance or recapitalize. In terms of our pricing policy, we have done a lot to make ourselves competitive with the big banks and the JPAs. One of the transitions that we made was moving from solely doing federal financing bank transactions, which were all taxable executions, to moving to the tax-exempt arena. So we've had to change the basis upon which we price from the 10-year treasury for tax-exempt executions to the municipal market data index, which is known in the market as MMD. We still use 10-year Treasury bonds to price taxable executions. Another sort of competitive change that we made is that when we were doing taxable financings earlier, we used to build all of the cost of issuance into the rate. And partly because the rate was just so competitive that we could do that and still produce, you know, an appropriate amount of proceeds to limit the amount of subsidy that we had to put into the transactions. Now that that FFB financing source has gone away and we have to move more toward market rates, we figured that we wanted to compare apples to apples. If somebody were looking at us versus looking at Citibank, and Citibank had them paying cost of issuance up front, and we had our cost of issuance built into the rate, it's sort of hard to explain why we're 50 basis points higher than Citibank on rate. And we didn't want this to end up having to be a story every time we approached a developer. So we have taken all of our cost of issuance out of the rate, at least the fixed portions for bond counsel and rating agencies and things that we actually have contracts for. There are certain variable components to the cost of issuance, like, you know, underwriter or bond counsel expenses and stuff. We're going to cover that by just adding a small element to our rate. I think we're going to charge like maybe 1% of the principal amount of the loan as, you know, as a one-time fee. So it would translate into, you know, 7 or 8 basis points in the rate.
Third-party cost or commitment cost?
Well, I mean, I guess we could. The problem, though, that we have is that the developers need to know what their costs are well in advance of us actually selling the bonds. And so we just figured that we would build the costs that we know because we have contracts for them up front, and then we would build just, I mean, because the variable parts are, yeah, and the variable parts are very small. Again, I guess and with respect to the mixed income program, we anticipate and will require that CalHFA be the conduit bond issuer and the subordinate lender. A developer may choose us to be the perm lender, but most likely they will choose one of the banks for a number of reasons that we can get into. The other programmatic changes that we've made are that, you know, we increased the application fee, not by a lot, but we were charging $5,000, we're now charging $10,000, and part of that is to make sure that developers didn't just put in an application to shop, in that if they gave us an application that they stood to lose enough money that they would only put in an application if they had a real deal that they wanted to submit for financing. The application fee, as it is now, will be credited toward the origination fee if the deal goes forward. And we're also looking at changing the amount of fee that we charge in our rates depending on both the size of the deal. The larger the deal size is, the more we will want to be competitive, so we might reduce our fees in that event. And, you know, with respect to affordability levels, I mean, the more units that we're going to get at restricted rates, the more attractive the project is to us. The last change that I think that I would want to talk about here is that we are changing our small loan program limit. We're raising it to $5 million from the $4 million limit currently in existence. I think that'll help us more attract more rural projects into our lending program. In terms of updated loan products, I'll go through this really quickly because a lot of it is essentially one product. The GSEs, most of the major commercial banks are all using balloons. For the most part, the GSEs are using a 35-year amortization with anywhere from a 15 to an 18-year term. A lot of that is because a lot of the stuff that they do in the affordable space are tax credit projects, and that's about the time that these projects either need to pay off their tax credit investors and resyndicate, or are in need of amenity upgrades and new money for rehabilitation. We have a waiver from HUD to do balloon loans that have a maximum of 40-year amortization and a minimum term of 17 years. So we believe that we can compete successfully with the GSEs because with a 40-year AM, we can give a larger loan. We think it's going to be very popular with the mixed income program developers. And because of the way our waiver is written, we can take advantage of another population, not-for-profit developers and some of the smaller developer projects. And particularly in our small loan project, we could do a 40-year AM with a 30-year term. That does a couple of things for us. The first is that it allows us to give a larger loan because of the 40-year AM. The other thing is that because the term is not significantly shorter than the amortization period, that there's much less of a need for an exit strategy or a refinance test to demonstrate, the ability of the project to refinance. The last thing that I would mention is that we have looked at the GSEs, we've looked at 4 or 5 of the commercial banks, and we've looked at 4 or 5 of our sister state agencies in terms of the exit strategy and the refinance tests that they have for balloon loans. And it appears that that entire segment of the market looks at refinance risk the same way. The GSEs are a little more number intensive than the banks and the other HFAs, but our policy is right in line with what the banks and the other HFAs are doing with respect to that test. In terms of succession planning, I think that, as we've stated, we're actively looking for a new director and a deputy director. We're also looking for a multifamily credit officer. We have taken apart the deal teams that had a loan officer, a loan admin, and an assistant, because we thought that if we took them apart and put all of the admins and the specialists in a loan admin group, it would allow everybody to get the same opportunities to do deals, and that you wouldn't have some people who were doing all the plum deals because they were very well liked and good, and other people who didn't have the opportunity to do those deals. So we think that breaking that up is a good thing. We have done some recent promotions, which I think is also part of what's making morale higher, because people are starting to see that, yes, there is a road to more responsibility and a higher position. We've been looking at, and I think a lot of these next bullets all relate to the same thing. We've been looking at systematically how to go from assistant, to loan admin, and loan admin to underwriter, and underwriter to loan officer, and trying to put in place ways for people at each level to gain the experience and training that they need to move to the next level. And that's going to be an ongoing exercise not only for this year, but for next year as well. And we are highly encouraging employees to look at external training to the extent possible to meet some of these goals. I think looking ahead, I mean, the numbers kind of speak for themselves. We expect all of these new programs to greatly jumpstart both our volume and revenue and begin to make us relevant again in both the first lien lending space and the conduit space. We believe that our portfolio preservation project is going to really jumpstart our ability to do first lien lending and on projects that are already in portfolio, which is a real benefit to our programs. We intend to increase our efficiencies in asset management. We're still looking at how we can better coordinate the activities of asset management and multifamily lending to make all of our processes a little more efficient and how we transfer information from one group to the other in an efficient way. And again, as I said before, we're constantly looking for training and growth opportunities for staff.
Awesome. Thank you. First, before you go, Kate, I know you have a schedule, so.
Yeah, no, thank you. I will have to take off early. I should say that my deputy director, Suzanne Haig, is here, and we're just getting the paperwork in order, but she will be representing us at OPR here as much as possible when I'm not able to be here. And we just really want to participate quite a lot because this is so central to everything that we're working on and the governor's priorities as well, of course. Regarding the governor's priorities, just I really appreciate you talking about the governor's priority of production. I just wanted to add a little bit of color to that. Well, and first, take a step back and say, so impressive what you've managed to do. I mean, this was an amazing presentation, and particularly on the numbers and the diversity and looking across the state, it's really, really just amazing. Thinking about affordability, it's just critically important to the governor, and I think to all of us, that affordability include things like transportation and access to jobs. We're all, I think, very cognizant of the increase in transportation costs to family budgets across the state, and just the fact that affordability no longer just means the housing cost, right? And as you're thinking about particularly a home ownership program, I'm really happy to hear you're thinking about sort of ADU pilots and other infill type strategies. Just encourage that. I think that's incredibly important, not just because of transportation costs and job access, but also some of the things that are really coming to bear on the state. Obviously, we are in sort of a climate crisis, and we're particularly in a climate crisis around transportation. So our vehicle miles traveled numbers are going up and up and up and up and up every year. Even as California is a leader on climate change, we are not a leader on transportation. We also have an air quality crisis in many parts of the state because of vehicles and vehicle travel. And we're seeing from the fires just the impact of social isolation on folks who are moving further and further away to more affordable housing and then unable to get out. And many of the people who died in those fires were older Californians who were very isolated. So we're really focused at OPR, and I think in terms of long-term planning for the governor's office on this question of how to really give people the opportunity to have mobility and be in closer to services, closer to jobs, closer to transit as much as possible. And just wanted to say that we just really hope to see that play out across the agencies, and particularly talk about that here, and really encouraged by what you've already done in that space. So thank you.
Thanks, Kate.
Thank you, Kate.
Preston?
I was just going to say, can we still be back by 1? I have things I have to do in Fresno later today, sorry. You're saying yes? So not an hour lunch.
So 20-minute lunch?
I'm okay if you did the 35.
Okay.
I'll try to be patient. It's not my strength.
Break for 30 minutes for lunch?
We take a 30-minute break for lunch. Preston can get to Fresno. All right, we're on a break. Thanks, everybody.
is yours.
Thank you very much for inviting me. I will admit that I sent these slides a couple of weeks ago before I went on vacation. Today's my very first day back of vacation. So there are a few things about these slides that are a little bit out of date, which I'll mention.
Irena, can we just maybe do
Sure.
a little background as to who we're talking to?
Oh, sorry.
So, Irena Admonson is the chief economist with the California Department of Finance, and she has been there since 2013. She serves the governor as his chief fiscal policy advisor and promotes long-term economic sustainability and responsible resource allocation. She directs the periodic economic revenue and population projections, reviews economic impact analysis of California's major regulations, and provides advice on economic policy issues. So I am so pleased to have her here because originally when we were going to schedule this, she was going to be out on vacation. So I was glad that she was able to be here today and provide us kind of a California's outlook. So with that backdrop, hit it, Ms. Admonson.
Thank you. Okay.
We are on vacation.
You are. It's actually very nice to be back. We were in Baja California, and the contrast between Baja California and Alta California is very striking. And I keep wondering every time I go down there, what would it have been like if the Californias had stayed together? But anyway. Okay, so I'm going to talk mostly about the economic backdrop. If you are going to stop paying attention right now, let me just tell you the one message, which is you need to build more housing in California. It is affecting everything about California's economy. It's really pushing up prices in California, and it is something that we regard as a huge risk if we don't actually build more housing. So this is from the governor's budget, U.S. and California unemployment rates. It has both history and it has our forecast, which is published on the Department of Finance website if you want to look at the actual details of that. So while I was gone, they did a benchmark revision. So some of these numbers are a little bit different. Over the last 6 months of 2018, they revised the unemployment rate for California to be 4.1%, which is about 0.6% lower than it ever has been since we started keeping records in 1976, I think. So we are really, really at what we would consider to be full recovery of the economy. The economy is firing on all cylinders. Everything is great. As an economist, that makes me worry a lot because if things are really good, you can see from this chart. So California is blue. The United States is the dashed red line. The light blue areas, those are recessions. I want to remind you that California itself does not have recessions. Those are for the U.S. But California is definitely affected when the economy goes into a recession. So you can see from this chart that the unemployment rate, it goes up, it comes down, it goes up, it comes down. It's really down right now. And in fact, my forecast makes it look as though we are assuming something that is a little bit unlikely, in that we are assuming that the unemployment rate remains very low throughout our entire forecast. This is because by convention, our forecast does not assume recessions. We can't date when the next recession is going to happen. And so we assume, what if the economy were to stay in this expansion mode? How would it fit together? Like how would everything have to work together to make sure that we do keep growing for the next couple of years? I freely admit that this is a little unlikely.
So this blue line here is not a recession by forecast.
That's right. It assumes that growth continues and that we continue to have this very low rate of unemployment.
But it also seems we have higher volatility in unemployment than the nation.
We do. So that's actually a great thing. I usually point this out. Thank you for reminding me. So California tends to have a number of industries that people turn over. People just switch jobs a little bit more frequently. And so over time, we just generally have a higher rate of unemployment than the rest of the nation. It's pretty unusual to find someone who works at the same job for 30 years. There's a number of people who work for the state government who stay in the same job for 30 years, but in private sector in California, that's very unusual. And so we just tend to have a higher rate of unemployment in general. And we tend to be a little bit more cyclical as well. That's what you're seeing. Okay, so this is California personal income, broken down by sort of the major source. And this is annual. The things that I want you to see is that generally speaking, we're assuming that it keeps going up. The red part down at the bottom, that's net wages and salaries. And I apologize, someone had told me this. If you are, if you're colorblind, this chart is going to be really confusing because the red and the green are right next to each other, and I've been meaning to fix that. I'm sorry about that. So the bottom part, that's net wages and salaries. That's the largest component of personal income. And then there's supplements to wages and salaries, which is things like benefits, your health insurance, if you're contributing to a pension payments, once they are going into your sort of like savings account, that's when they show up in personal income. When you are drawing down your pension, when you are getting 401k withdrawals or whatever, that doesn't actually appear in California personal income. So as we get a larger proportion of people who are retired, then this series, which is the economic series of personal income, is going to diverge a little bit from what we call taxable personal income. And taxable personal income is, in fact, going to be a little bit higher than the economic series because more people are going to be drawing down their pensions. Okay. The one exception to that is transfer receipts, which includes Social Security payments. So Social Security payments are considered to be something like unemployment insurance. That also means that during recessions, you can see, as opposed to the dramatic ups and downs of the unemployment rate, personal income basically goes up. It maybe goes down a little bit, but basically it keeps going up, and a lot of that is unemployment insurance and other forms of insurance. Proprietor's income, that's business income. So if you own a business, you are taking your profits, that's what comes from proprietor's income. Yes, this is another great question. No, I'm glad you're asking about this. So when I first started looking at this series, I thought that rents are really high, it should show up in income for someone. But because the way it's accounted for, because it's net of expenses and because of you get depreciation and landlords get to write off a whole bunch of things, it doesn't actually show up as larger amounts because in the definitional terms that we use for this series, it doesn't show up as extra income for them, even though they are getting a much higher cash flow. Yeah. Okay. This is California residential construction. Single family is red, multifamily is blue. You can see the huge boom before about 2006, 2007. Most of that was coming from single family. Post-recession, you can see just it really fell off. It was below 50,000 units. This is monthly, by the way. But it's annualized so that it's comparable across time. We were getting about 50,000 units per year. That is nothing. We did a calculation a couple of different ways, and we found that probably about 180,000 units is needed just to keep up with population growth in general. We have now revised that to be a little bit higher. So now we're saying probably you want about 200,000 because there's been destruction from wildfires that's been higher on a continuing basis. And also when you get infill, you have to tear down a bunch of houses to build more multifamily housing. So there's a higher rate of demolitions that we're seeing. So we're kind of benchmarking and saying, well, to keep up with everything, you probably need about 200,000 every year. You can see from this, we're nowhere close to that in the history. We don't even come close to that in our forecast, which we've been told is very optimistic. So this is a very particular assumption in our forecast right now. We assume that housing pressures ease, and that is what allows continued growth in California. If that doesn't happen, then it becomes very unlikely that you can continue to have this continued growth in California. Oops. Okay. This is a new chart that we put into the governor's budget this year. I'm actually very proud of this chart. This is one of my new favorite charts. So this is constant size adult households. So over time, household sizes have been creeping up because if it's more expensive and people can't move out of their parents' basement, then households tend to be a little bit bigger. So what we wanted to look at was adult households, which we are defining as, I think, 25 and older. And I divided by 1.75. because that allows for some people to live by themselves and some people to live with a spouse or a partner or to have roommates. But generally speaking, that's the number of adults. And then we also looked at the stock of residential housing units. So not just single-family houses, but also just all of the apartments and everything. So the blue line is residential housing, the constant-sized adult households. You can see that in 1980, there were far more residential housing units than there were constant-sized adult households. And the number of people who have kids and the number of kids in our population also varies a lot over time, which is why we did it on the adult household basis. So you can see that they're sort of like converging. We're not building enough housing all through the 80s up to about 2000. That massive boom that we saw from about 2000 to 2006, that was just keeping up with the adult households. So those two lines are right on top of each other. And then after that last recession, we haven't been building enough, and you can see the growing gap. So you can quibble about sort of like how many adult households you really need, but I thought that this was a really great illustration of sort of the overarching trends over time. And so this really, to me, says, wow, maybe that boom that we thought was just a bubble and way too much, maybe that was just keeping up with what we needed. One of the ways in which you can see this is travel time to work. So as we're not building enough housing, and as jobs remain concentrated in urban areas, then the amount of time that people have to spend commuting just keeps going up. This is not exactly in keeping with our goals of reducing emissions, especially from travel. So this contrasts 1990 to 2017. And this is an absolute sort of like numbers of people who fall into different buckets for how long it takes them to get to work. You can see there's a huge increase, by the way, in that leftmost column, which is below zero. So those are all the telecommuters. So the number of telecommuters in California has risen from about a little bit less than 1 million to, I think, about 1.8 million. So it's almost doubled. Even with that, there's a huge increase in the number of people who it takes longer and longer to get to work. This survey tops out at 90+ minutes, but I think we've all read the stories about people who are commuting 2 or 3 hours each way to get to work, which is just crazy. Okay. On our website, if you want to look at these things, they're called population pyramids, and they have males on the blue side and females on the red side, and it's the number of people at each age range. So you can see that there's a number of kids, and then there's a huge bulge in 2000 in the working age population, and then as time goes on, people tend to die off. They're called pyramids because when they were first constructed, they really did look like pyramids. There were more young people than there were older people, and they just kind of looked like a triangle. Now in California, by about 2020, it's more like a population cylinder. So we have a much more even age distribution, and we have far fewer people who are in the retirement age, which is good. I hope to live to retirement age and have a long and happy life. But it also means that if those people remain in their homes, which they bought when they were young working families, and those homes are the ones that are close to where all of the jobs are, then that means that everyone else who is now of working age has to commute for longer. So there's some trade-offs here. These trends are only going to continue. The birth rate continues to surprise us on the downside, by the way. Unfortunately, on the other side, so there's 2 ways in which population can increase. Well, 3 ways. You can get more immigration, you can have a higher birth rate, and you can get longer life expectancy. So fewer people die than you think. Over the past probably about a century, life expectancies have been going up. Over the last maybe like 5 years, life expectancy increases have kind of stalled. In the rest of the US, a lot of that has been due to opioids. The other part is due to what people are calling deaths of despair. So poor people who were laid off of work find it very difficult to find new work. They tend to just have higher death rates. And so there's a huge sort of income inequality link here in terms of what your prospects are and how well you're doing and what your death rates tend to be. So, okay, this is kind of a complicated chart, but it's my other really favorite chart. So this is labor force and working age population. The gray areas are also recessions so that you can see what's going on. This goes all the way back to January of 1995. It's monthly. So the bottom green parts are the 16 through 24-year-olds, kids these days. And so the green parts are, the bottom part are the ones who are employed. The darker green ones are the ones who are unemployed, which means that they are out of work, but they're actively looking for work. And then the light green part is the ones who are not even looking for work. They're either in school or they're living with their parents and have that as a means of support, but they're just not in the labor force. And then in the blue parts, those are the 25 through 54-year-olds, what we kind of call the prime working age population. Again, you can see the ones that are working, the ones that are unemployed. Note that it's a couple of years after that recession where the number of unemployed people is the biggest. And then there's the number of people who are just not in the labor force, they're not actively looking for work, and they're not working. There's always going to be a certain number of people who choose to stay home to look after elder parents or to look after kids, or maybe those people are going back to school for a second time or for the first time. They're just not in the labor force. The top part, so those two are basically flat over time from probably about 2000 actually, to most recently. Those two make up it's just flat across time. It's not growing. All of the growth in the labor force and in the working age population is in the 55 plus. So again, they have a much lower labor force participation, but more of them are working. You can see that because there's a larger sort of dark pink area at that bottom. Relatively few of them tend to be unemployed because they could be retired. If they're not finding a job very easily, then they're not going to keep looking. So relatively few of them are counted as unemployed. And then there's a huge portion of them who are not in the labor force at all. They've basically dropped out. That becomes a little bit difficult if, for example, they don't have much in the way of retirement savings. One of the risks, we've been warning that there's probably a new recession that's inevitably going to happen at some point. One of the risks for the next recession is that there's going to be a much larger share of the population that is of retirement age. There is unfortunately ageism, and it is much more difficult to find a new job if you've been laid off if you're over 55. We see that in the data, and so if you don't have much in the way of retirement savings, if you're kind of in an insecure situation, if you've been a renter your whole life, it's going to be really difficult for you after the next recession, probably. Okay. Even though we don't forecast a recession, we do run recession scenarios. So I'm not predicting a recession in the middle of this year, but we wanted to do sort of a what-if scenario. So what if there were a recession in the 1920 fiscal year? So what if it started in July, lasted for the entire fiscal year? What would happen to our revenues? What would happen to our economy? And basically what we said was over a 3-year period, our general fund revenues would drop by about $70 billion, by up to $25 billion in 1 year. That's a lot. Our current general fund is around $130 billion. So this is a significant drop. Well, depends on how you sort of look at it. The budget stabilization account is approaching about 15 billion, sorry. It will be fully funded because it's sort of capped at 10% of the general fund. There are a number of other places where there's kind of like savings. And so if you take a very expansive look at that, then it could be as much as 30 billion. The state also has paid down the wall of debt, so we don't have to worry about cash situations either. So all of that is to say, we don't have enough to perfectly smooth out all of the spending, but there will be a little bit more time to consider what kinds of actions the legislature would want to take and the governor would want to take. Okay. So one of the things that we often talk about is the state general fund is very reliant on personal income tax. So probably the best way of thinking about that is 2/3 of the general fund comes from personal income taxes. About half of personal income taxes come from the top 1% of taxpayers. So about 1/3 of our general fund comes from the top 1% of taxpayers. We do not assume that there is a lot of flight from California as a result of the federal tax law changes that happened at the end of 2017, but it is definitely a risk that we talk about. The other way to look at it is that we don't have a great sales tax base anymore. So in terms of spending, people spend far more on things like healthcare and on things like housing. So taxable sales, which is just on goods, has been going down over time. This goes all the way back to 1969, I believe. There's recession shading, as you can see. And it's gone from about 50% of personal income down to, I think it's about 27% as of our last reading. So sales tax is a far lower share of our general fund at this point. And part of that is high housing costs. The other statistic that I often quote is, and this one shocked me, was 1 in 5 California households pay at least 50% of their household income in housing costs. So that means that if you were in a 2-earner household and you're paying 50% of your income and one of you loses your job, you basically can't live. And that is just horrific to me, especially because that's 20% of households. That is a lot of people who are very...
Families are paying 73% of their income.
Yes.
So it's not even if they lose a job, they're already burdened
Yeah.
making those
Yeah.
tough choices of, do they pay their utilities or buy food or pay rent?
I've also seen work which is not done by official surveys, but is done by academics that are saying a lot of the homeless are actually working poor, and they just can't find someplace to rent. And this was the other contrast with, I walk around Sacramento, and I come from the train station every day, and I see a lot of homeless in Sacramento. When I was in Baja, there was far more poverty, and yet there were no homeless people. Because you can basically, find someplace to live. It's not going to be pretty, and it might not have what we consider to be, very nice accommodations. But there's basically no one sleeping rough, because you can always put something together. So, not exactly a solution for California to have shanty towns, but if it does, make you think.
Income.
Oh, you are asking all the good questions. So debt payments as a percent of personal income, that's a little bit more difficult. There are surveys about what people spend their money on and how much they have in terms of savings and things. And a lot of the new, a lot of what people have traditionally looked at has been in terms of mortgage debt, because that traditionally was the largest share of debt. In terms of the aggregates, and people are now putting together different sources to try and figure out exactly how big that problem is. The one thing that is much more difficult to deal with student debt than other kinds of debt is that it is not dischargeable in bankruptcy. And that is also very troubling to me. It's not like you can mail your keys back with a mortgage, There's sort of a set process for getting out from under that. There are the income repayment schemes for student debt. The recent evidence from the federal level shows that that's not working the way people maybe expected it to work. The other thing that I will point out is, for example, in Spain, mortgage debt is also not, you have to keep paying it even if you go through bankruptcy. And in Spain's case, that really, really delayed their economic recovery because it meant that people couldn't have a fresh start. And so the ability to sort of both parties, the lender and the borrower, to say, this isn't working, we have to do something else, like, I know it's going to be hard, but like, let's just call it a day, and have some sort of process for that. That seems to be pretty important for future economic growth. And with student debt, that's not possible. Final slide. Oh, sorry, a couple more slides. This is the S&P 500 index. This is one of the other risks that we warn about. Again, there's recession shading here. It goes back to 1995. You can see that, and this I cut off, I think, at the end of 2018. So I haven't updated it since the end of 2018. It goes up, it comes down, it goes up, it comes down. It's pretty far up. I think it's been fairly plateaued for a while. But usually what this chart shows is that it comes down. So to me, I look at this chart and I think, oh, I cut it off right before it starts to go down. Hasn't gone down yet, but will probably happen at some point. Okay. All right. California state revenue by source. This is what I was talking about earlier a little bit. So this goes all the way back to 1950, because my staff put together this chart and I thought it was interesting, so I kept all of the years. So it's 1950, 1960, 1970, 1980, 1990, and then it sort of is more recent. But you can see the retail sales and use tax used to be a much larger share of California's general fund. Now, there were some big changes here because the state government took on educational funding after Prop 13 and then Prop 98. And so there have been some structural changes that mean that personal income taxes had to become a larger share of our general fund. But I still think it's pretty instructive. People also often ask about the estate tax. There's some legalities about how we can't have an estate tax unless the federal government does something. So if you're thinking about doing an estate tax, it's more complicated than just solving all our problems. Okay. This is the part that I don't actually usually cover, but I wanted to put it in from the governor's budget. These are sort of some of the allocations. And I'm just going to stop there. I will note, so California is a large state. It is a relatively wealthy state. People spend a lot of money on housing. The governor's budget allocates quite a bit of money towards housing and trying to increase the supply of housing. But if you look at the overall scale of the problem, it is one that is extremely difficult to say, well, all of the solution is going to have to flow through the general fund because the general fund just does not have the scale there. So I will end there. Any other questions that I can answer?
Thank you so much for your presentation. There was seen a couple of studies about the loss of economic activity due to the shortage of housing. Do you have any numbers around that? And our next speaker may have some of that too, but or is that more mushy-feely?
You know, I've seen some of the same studies. We haven't done estimates of that.
Okay.
And I'm not comfortable giving estimates of that because there's a number of different channels by which this can happen.
Okay.
Yeah.
Thank you.
I love your presentation, needless to say.
Oh, thank you.
You speak to me.
We see that.
Build more housing.
If you'd ever like to come to San Diego, if you have the opportunity, we'd love to create an opportunity to highlight some of this. I think there's important concepts here, and I think visualizations are absolutely critical for folks to get a sense of scale, relative scale of things. So I appreciate your taking the time today.
Thank you.
Thank you, really appreciate it.
one of your favorite slides, which is now one of my favorite slides, which compares the adult households to I can't remember what the two are. The only mitigation I just mentioned out there, which is probably worth just some thought, is that over the same time period, we've also seen the size of construction going up. So the size of the average single-family home in 1980 versus the size of the average single-family home in 2018 over that 40-year period may have 20 to 30% more square foot associated with it. So that may be mitigating a little bit of that line crossing phenomenon, in the sense that you might not have had room to keep your in-laws in the structure back in the structure you live in 80, but you might have that in 2018. So worth putting that in the mix.
That's actually a great point. And we probably should try to look at square footage in terms of this. The reason why I think units is a pretty good measure of it is that people also kind of demand more space now.
Well, yeah, that's it's a cultural issue.
Yeah. So I actually live right now about a block away from where my dad grew up in the 30s. And, he had 5 siblings, and it is a tiny house. But that was totally normal, Like he was going to share his room with his 3 brothers, and, his 2 sisters were going to share a room, and that was totally normal. And, they were going to have a tiny little kitchen, and their parents were going to chase them out to play, and they were not going to be inside doing stuff. So there's absolutely the square footage. The other thing that might be mitigating some of this gap is that we don't actually have a great handle on accessory dwelling units.
Yeah.
So there could, in fact, be a larger stock of housing out there than what we think there is. Right. Especially if locals decide to sort of normalize these things. But even so, I don't think that the scale of those is quite going to make up the gap
I don't
there.
suggest it is.
So it might mean that we have less of a gap, but there's still going to be a gap.
Yeah. Very interesting. Thank you.
Yeah. Thanks.
One more question. Going back to the relative sources of income at the state level, can you trace any impacts from 2 events, Prop 13 and the death of redevelopment? Did you see impacts? You passed by it at some point here.
This one, I think.
No, I was looking at, but there's also there's another which has more bands of.
For the general fund. That's pretty close.
Yeah.
To the end.
Is that, no,
This one.
There we go.
So the end of redevelopment should actually go the other way. I think that would have meant that sales tax would have increased.
As relative proportion. Okay. I just want to see how sensitive this would be, and whether, since so much has passed through. Okay.
Yeah.
I of course, I have tons of questions, but I was fixated on one spot, which was the idea that as households, as people are getting older, that they're staying in the house that was near the employment center, right? And then I started thinking about what's our policies, right? We give huge real estate tax deductions to seniors, right, to keep them in place. So I'm kind of curious, do you have any kind of policy thoughts around that, or are you just kind of saying this is interesting? Seniors are in these overhoused, great spots next to transport, next to economy corridors or whatever, next to jobs, and that's just interesting.
I think I will leave my comments where they are. Yeah. Sorry.
Well, then I'll say it. I think we gotta think about that then, right? I mean, it seems kind of
incentivizing.
What are we incentivizing? And
Many people have told me that Prop 13 is untouchable, but.
Is that Prop 13 thing in your mind?
Third rail.
What about is it Prop 50, the ability to migrate your AV to a different home?
Right.
And that just got limited, I know, but I'm curious if that's something you've looked at, of people taking their Prop 13 protected AV and migrating it.
No, but I think there's a limited form of that that
Within
already
the same
exists.
county, you can still use it, and then some counties have reciprocity agreements.
Yeah.
I'm just curious.
There is also one other, so as I go around the state and as I talk to locals, and as they sort of like tell me about the incentives that they face, one of the issues with having sort of like that protection for homeowners in terms of sort of the predictability of how much they're paying in property taxes. That means, so there is no such protection for the locals in terms of funding for the demands on services that those people demand. So the expenditures can go up much faster than what the revenue sources can go up. And so this leads to an incentive whereby there's an incentive to zone for business development, because then at least you can get some sales tax and some payroll taxes, or you can do business taxes. But and so zoning goes away from housing, and you know that can be intensified if, for example, it becomes even more attractive to zone for businesses.
So there was a professor from the Price School at the unaccredited university down in LA. Spoken from, yeah, with UCLA, obviously. That he showed the, you know, the interconnectedness between generations, and yet seniors or people over 55 were making decisions that seemed to be in their best interest, but were really harming them when you looked at the implications on what it was doing to other generations, and those other generations, how they support seniors. So I do think that somehow we've got to get people to not be thinking about their own like short-term best interests or what they think is their best interest, and broaden the conversation, especially if we're going to have an aging population that's going to be, you know, making decisions, voting, and voting in a way that probably is not healthy and beneficial to everyone in the community.
I will note that I did think that there would have been pressure by older homeowners who wanted to see their kids be able to move into the same communities that they lived in to have their family around. But what seems to be a pattern is that the wealthier homeowners who benefit from the higher asset prices, they just lend the money to their kids. And so it's not an opportunity open to all, it's sort of generational wealth transfer.
The demographic bulge chart you have, does that, have you looked at all at the geographic sort of, variety within the state?
So,
Sorry, what variety did you say?
How it varies by, you know, coastal versus inland.
Yeah.
There's an economic display to that too, in age.
That's a great point. So, for example, if you looked at the population pyramid for San Francisco, it looks like a Christmas tree. There's like basically no kids. So it's really skinny on the lower part. There's this massive bulge where all the tech bros are. And then it sort of, you know, goes up in a pyramid shape, where once people retire, they tend to sort of sell out and leave for cheaper places.
My last question. So like on the unemployment rates and that chart where you did California to the US, I remember when there was that proposal floated to break California into 5 states, that the Valley would have become, if it became a state, would become the lowest income state per capita in the country. So I'm just kind of curious, how much does the Valley affect the rest of California? I mean, we're probably only 10% of the state population, so.
I think it's actually a little bit less than that. You know, let me get back to you on that.
I was just kind of curious, does that change if you take the Valley out of the unemployment rates? And
so, you know, you could probably look at, we've looked at a number of different regional breakdowns. If you just look at LA, for example, LA looks very much like this, because LA is sort of, you know, it's just so large that it shapes everything. If you looked at, so usually we'll do the Bay Area, LA, and then kind of like the rest of California. Sometimes we'll break apart San Diego. But unemployment rates tend to be higher. They do tend to follow the same pattern. They are doing better, but their lowest unemployment rates just tend to be like a couple percentage points higher. So I think there are still some counties that are maybe over 10% unemployment still.
Okay, thank you.
Yeah.
On the population screen again.
Sure. The
I
pyramids?
recently listened to an economist in Texas who indicated that the birth rates were going down because of housing, because of lack of housing and other economic factors. And so they were beginning to forecast that those rates would eventually start to go down over time. I'm wondering, is that something that you might see happen here in California?
You know, right now, that's kind of speculation. We think that it's probably affecting things because if you can't find a place to have kids in, you know, if you're living with roommates right now, it's a little bit difficult to imagine staying with your roommates and adding a baby to that conversation. What we did see was during the recession, birth rates did go down by a lot. And we think that that was associated with economic factors in the sense that, you know, people just didn't feel confident in their circumstances enough to have kids. With the ACA, there was also much better access to birth control, and so people could choose. We thought that there would be a rebound afterwards, which we haven't really seen. Part of that could be related to housing, but it's really difficult to disentangle the causal effects. It could just be that, because lots of other countries also, as they become richer, as people become more educated, they do tend to have fewer kids. So we could just be going through that kind of transition.
Mr. Chairman, we have a public mic, so if anybody in the audience would like to ask any questions, or I just wanted to share that with you.
Anyone want to ask questions? All right, well, Irina, that was awesome. That was very good.
Thank you.
Just when you think the Department of Finance knows everything, there's a little more they know. Great. Thank you very much. All right, Shannon, you're up.
And while Shannon's coming up to the mic, I want to take a little opportunity to provide a little background. Shannon is at Pelican? Is a partner with the McKinsey San Francisco office and leads the McKinsey Capital Projects and Infrastructure, Electric Power and Natural Gas and Sustainable Practices. She brings extensive experience serving both public and private sector clients in infrastructure, transportation, and utilities. Some of her recent accomplishments include drafting housing objectives, the strategy to meet those objectives in a large North American city, and reviewing global public transportation systems to define optimal public transportation system to drive service performance, increase cost efficiencies, and improve overall system financial viability over the long term. Her prior experience includes working with the Office of the New York Metropolitan Transportation Authority, and outside of the McKinsey Group, she serves as chairman of the New York Metropolitan MTA.
I wish that was the case.
No, she serves as the University of Minnesota Carlson School of Management. See, I'm getting my lines mixed up. Undergraduate Advisory Board, as well as the San Francisco Center for Economic Development. She has her MBA from Stanford University and a bachelor's degree in business and marketing, and graduated summa cum laude from University of Minnesota. And I am just so pleased to have her here because she was instrumental in the report, the McKinsey report on housing that she is going to be talking to us about. So
3.5.
Thank you. Yes, thank you for that introduction. And it's nice to see some faces around here. Ben, apologies for having to see this one more time. I'm excited for this next round of questions. And Irina, it's great to see you as well. Want to preface this that this is work that we published in 2016, so it's a bit old, but I do think it still does a good job of setting out at least the macroeconomic environment that we had outlined back then. And let me just spend a little bit of history around why the heck McKinsey even invested in this research that we did for ourselves, essentially. In 2014, we had published landmark work on affordable housing in emerging markets or developing marketplaces. A lot of information, a lot of perspectives on what to do in greenfield markets, in what to do when you're expecting mass urbanization on a scale unseen before. And while we came out of that feeling really good about that perspective, when we looked at places like Hong Kong and London and San Francisco, we realized that a lot of the things that we had learned for affordable housing in those marketplaces didn't translate. And so as we looked around our neighborhood and thought, where could we find a good example of, affordable housing needs in the developed economies, we came to California. And that's the research that we undertook in 2016, which is to say, how do you start to think about sizing? Is this actually a problem? How do you think about the size of the problem? Is it as pervasive as people say it is? And then how do you start to get a handle on ways to impact things to improve that problem? So that's the context by which we undertook the work. I'll just touch on this briefly. These are things that you likely know, but it's good context. So as we think about, is there a problem? One of the great starting points is when you look at California's population and incomes, good news stories in most places, in the majority of places. Increases in population, increases in household incomes. So good news, things should be looking up. And I think Irina spoke to that a bit earlier today. But if you think about then supply actually meeting that demand, so we have increases in population growth, increasing income, how did that actually translate into housing that increased population or meeting expectations for different types of housing as incomes increased? What we found is that similar to the takeaway that you heard earlier, California is not building enough housing to meet that demand. How do we start to size that prize or to really try to quantify the extent of the problem? We took a basket of peer states, and similar to what we do in our private sector work, to just try to compare and understand where do we stack relative to other places that folks might consider living or working, or that we would say, hey, we want to be as good as or better than. So we took a look at places like New York, New Jersey. We took that you could consider peers from an economic perspective, a land use perspective, a demographic perspective. We took a look at Western states that border you, as you think about kind of how you try to keep folks in your neighborhood, where are there alternatives. And then we took a look at places like the Washingtons and the Oregons and the Texas of the world to say, other burgeoning tech hubs that are on this side of the Rockies, what else could you look at? And if you took a look over the same time period, you'd see, we just did a bit of a rough cut around population added, housing units added, and the ratio of housing units added to population added. Give us a rough sense of how good of a job are we keeping up with demand. And you can see that we're at the bottom of that list. I think this is one of the then candidates, now governors' favorite sound bites, is if you actually look at that per capita added across these states, we added about 80% less housing units per capita than New York did over that same time period. Okay. So that's a snapshot over a 5-10 year period. Was there something else going on? Was there an underlying structural supply issue that we had to address? And so we took that kind of same basic, easy math and said, let's just take a look at housing units per capita. What does that get us? This is another, I think, stark stack, which is if you take a stark stat, if you take a look at that on a state-by-state basis, we come in 49th out of 50th in housing units per capita. And I will not comment as to why Utah might be at the bottom of that list. So,
difference.
Again, we would hypothesize that the basis is around household construct. Yeah.
So if you did like the both at the top right. Okay, sorry.
Yeah.
Took me a little while to understand.
Yep. So here's how we started to think about the problem. We have a supply issue. Supply isn't keeping up with demand. It hasn't kept up with demand over the period of growth that we were evaluating, and importantly, that was creating a problem that had already existed. So our backlog, if you will, was pretty significant in terms of supply issues. Before I flop to this chart, let me just spend one more moment on this. So let's take New York and New Jersey, and we can debate whether or not those, again, are good comparison states, whether or not they have a good balance of rural versus urban, how you think about their economic kind of socio-demographic split. But we thought they were an interesting comparison to say, gosh, if you take a look relative to any other state in the union, and we dwarf everyone in terms of population, in terms of income, all of that good stuff. But we tried to say, you know, if New York and New Jersey are kind of as close as you can come to some of our aspirations around global economic hubs and inclusion, they're not that great themselves, but what would it take to actually get there? So you'll see that they rank 41 and 43rd. So as we started to think about how much supply might we need, we're not aiming to be middle of the pack. We're not aiming to be top of the heap. We're actually saying, what would it take to be a bit more aligned at the top of the bottom 20th percent?
A bit less bad.
A bit less bad. We're looking for a passing grade, D plus, C minus, depending on how you think about it. So that tees up how we thought how this 3.5 million number came up. If you take a look at current demand, which is essentially the number of housing units that California needs to supply to get to that same per capita rate as a New York or New Jersey, so again, to be at the top of the bottom 20% of states, that gets you to about 16 million homes. And this is, again, based on information from 2014. So assume this needs to be refreshed a bit, but it gives you a general sense. At that time, California had 14 million homes. And so we'd say the current backlog then is this a 2 million home gap. If you think about the anticipated growth over the 10-year period, about thinking, again, if we can grow at our expected population growth rate, but mirror that at a housing per capita rate similar to New York and New Jersey, that gets you to another 1.5 million homes. That brings our total housing backlog to about 3.5 million homes, which is the stat you've heard so many times. You subtract out the new units at current construction rates, which fortunately have been boosted up the last couple of years. At the time that we were looking at it, was just kind of coming out of 2010, 2012 in terms of construction data, and that was about 100,000 homes a year. You say, gosh, we're going to make 1 million homes then over 10 years. That gives us to a $2.5 million home gap to fill by 2025. How do we get there? And can we do it? So now we've sized the problem. It exists, it's big. Where is it? And this is where we did a bit of a demographic slice, simply by income, across all major MSAs in the state of California. And not only do we know the problem is big, but this information helped us understand that it is everywhere. There is not a county in California that doesn't have at least 30% of its population that is burdened by housing costs. And in the worst areas, it's up to about 60%. The worst MSA that we found in our research was actually Santa Cruz, Watsonville, at about 67% of households being burdened by housing costs. And we define that as spending more than 30% of household income on housing.
That 2368, what is that?
23.
LA.
Is that Los Angeles?
Yes.
Okay.
Yep, and you'll see, so order of magnitude, similar to what you'd expect given where your population centers are. That's just, how big LA is, and it dwarfs everything else in comparison. So it's big, it's everywhere. I think one of the other pieces that we wanted to myth bust a little bit is when you say affordable housing, oftentimes there's a connotation for very low income or extremely low income populations. And when we did our demographic cut, again, just based on the 34 MSAs geographically, then we looked at 16 different income bands, merged those into the 5 that you see here. The stat that just floors me is, if you look at the very low and extremely low income, it's impossible. Housing is impossible for those demographics. And importantly, if you look at moderate and low income, you have, more than half of moderate income folks across the state of California who are unable to afford housing, meaning that they're spending more than 30% of their household income on it, which, as everyone on this panel, I'm sure, understands, forces really hard trade-offs on other basic necessities. So not only is it big, not only is it pervasive, but holy smokes, it impacts a much broader percentage of the population than perhaps the term affordable housing historically has kind of gathered up for folks.
So you're saying very low and extremely low just can't even afford to be here?
What we have here is that for very low and extremely low income, 3% of those folks are not spending at least 50% of their income on housing. So because we're business folks, what does this actually mean in terms of what's the business case behind also fixing this problem beyond kind of the individual level? If you think about the dollars that people are spending above and beyond the 30% of their income on housing, that represents $50 billion in lost consumption to other things outside of housing. In terms of lost economic output per year, there's two things that we took a look on. Two things that we quantified. One is what's the impact of the construction sector. So this kind of lost economic multiplier of not having enough homes built, not having the construction sector kind of as actively engaged as it could be, which we know has a multiplier effect on the economy of every dollar spent in construction is about $2.15 in the general marketplace. Big impact. And then additionally, as you think about, again, those 16 different income brackets that we had segmented across the state, if they had those extra housing dollars or those extra dollars that they're currently spending on housing and use their same consumption patterns, what would we expect to see in different durable goods, services, consumption, and what would that represent? And that's what the $140 billion adds up to, or what adds up to that $140 billion.
So this is the question that I had asked Arena, but because of the various factors, she was not able to answer it. But how big is our general fund budget a year? Isn't it 130 billion? How much is it?
Jolie will know that.
130 billion. So according to you, we are losing more on an annual basis in economic output than we are funding with our general fund.
Yes.
I want you guys to just think about that.
So I also saw, I think it's the Urban Institute has done that shared prosperity study, right? That shows, well, I'm picking on Fresno, since we're 55 or 59 out of 59 cities in California in shared prosperity and 260 out of 270. But shared prosperity also plays a pretty big role in economic, it's like the local GDP, I don't know the right term, right? So it's kind of interesting to think about the wealth kind of gap is actually leading to less economic activity.
Yeah, and I would say that if you think about the San Joaquin Valley, for example, and you go back to this chart that we
That's all I think about.
If you go back to this chart, it's one of the few places in the state that actually didn't see the same change. You saw a negative household area median income over the same period.
Mm-hmm.
So that just magnifies your point. So that's the bad news. The good news is, part of, as we think about the work that we do, again, a lot of it is just asking putting together good problem statements and then trying to figure out whether or not kind of the mythology that exists around it is true or not. So one of the other things that we found is yeah, it's a big problem. That's because there's not enough space to build what we need to build. And so we used some geospatial analytics and a lot of good publicly available information on what would it take to do we actually have this space? Are we capacity constrained? Is this a different problem? Do we need to start, thinking about how to roll out into the Mojave Desert and do something differently there? There are 5 different tools that we looked at to quantify where you could put supply. One is building on vacant urban land that cities have already zoned for multifamily. So where are these kind of pieces of golden opportunities that just haven't been taken advantage of? The second is, how do you think about intensifying housing near transit hubs, especially given the alignment with mobility goals, given alignment with affordability goals around access to good, cheap, reliable transportation? And I should clarify here, this does not mean, we're building Hong Kong in Bakersfield, but rather thinking about how do you take it up kind of to the next dense level that makes sense for that particular region. So there's a variety of nuance in that number. You can see it is by far the biggest lever that exists in terms of actual housing production. There's add units to existing family homes. So this is things like accessory dwelling units. This is things like conversions to co-living, cooperative living, that type of thing. Adding units to underutilized urban land zoned to multifamily development. We define underutilized land as you take a parcel, say it's zoned for 10 units, and it has only 4 units on that particular parcel. Anything that wasn't utilized to 50% of its current zoning, we classified as underutilized. So again, there's a trade-off there, but the intent was to highlight this doesn't require new zoning. Can you deliver the units that were intended to be there when the original zoning was put in place? And then finally, where do you think where is it appropriate for affordable and adjacent single-family family housing to exist in line with smart growth principles? So again, thinking about access to transit, thinking about access to employment centers, that type of thing. Please.
Clarify what the assumptions behind intensifying housing around transit hubs. Are you talking about existing zoning or kicking things up a notch?
Isn't that SB 50? Isn't that the Wiener bill?
It's a version of it. It's kicking things up a notch, but not necessarily to, again, something that wouldn't be community appropriate. So if you wouldn't mind, let me see if I have this slide in there. I can show you.
That's a special. In San Diego, we just eliminated parking requirements along in transit priority areas. Second reading next Tuesday, so we're not going to count our eggs yet, but that's, I assume that's.
Shannon, before you go off this slide, if I could ask about existing single-family homes and underutilized land, those 2 bars. If you took like Minnesota and just said if it's an existing single-family, you could do 1 to 4, and you could just do it by right because it's already zoned that way. And if you took underutilized, that was like you said, it had already been zoned for 10, and you just brought it up to half. So if it's 4 units on it, if you just add by right and had allowed them to just do 1 additional unit, you're saying we can get to that 341 and 582 conservatively and 793 and 993 on the high end?
Yeah.
Okay.
Why don't, if you're interested, I'd love to just go through each of the assumptions, because I think this crowd probably appreciates more than most. So in terms of the ADU number, what we did is we essentially took, this is one of the kind of few top-down numbers, and I guess it's add units to existing single-family homes was actually 3 things. Like I said, it was ADUs, cooperative living, co-living. That assumption says across the state, across those 3 categories, we anticipate only 5% of homes will actually take advantage of that. And so that low end represents about 2.5% or about half of that 5%. And the high end represents 3% uptake on ADUs, 1% uptake on co-living, 1% uptake on cooperative living. So not crazy, we're not expecting 10%, we're not expecting, but it is something there around when we did take a look at this, especially in the city of San Francisco, who was doing some interesting things at the time, we essentially tried to kind of convert some of their outcomes, and we can argue about whether or not that was a good assumption, to say, gosh, they're getting actually 7 to 8 to 9% uptake. We don't think that's realistic for the rest of the state. Let's cut that in about half, and then let's think about that from both a low end and a high end. So this represents about, a third to a half of what has been experienced in some of the cities who have been experimenting with this. In terms of the underutilized multifamily homes, that the low case is basically what if you get to that 50% mark. The high case is what if you get to the actual, fully maximized zoning potential. For the transit, let me get to this. So first of all, we did this at a pretty granular level. So we did this across all of, again, kind of a parcel by parcel look. using geospatial analytics across all transit hubs for the following transit agencies: Caltrain, ACE, Coaster, Metrolink, Amtrak, BART, San Francisco Muni, Metro, Sacramento Regional Transit, Sprinter, San Diego Trolley, Santa Clara VTA, the 12 proposed California high-speed rail stations. We can also debate whether or not that will happen. And the ferry terminals in the Bay Area, planned bus rapid transit in Fresno, and a few other regional bus systems. So we tried to be pretty comprehensive.
It still sounds like a smaller universe than even the TPAs as defined in state legislation.
And I can show you, I'm happy to follow up on a couple of different charts that I wish I had put in here that will actually show you kind of where we linked. What we didn't do is include things like the Mendocino bus routes, because we just never thought you'd actually get density there that would actually make sense to kind of upzone. So we broke this into we then broke those transit hubs into 3 different classifications, if you will. One is around urban centers, and those urban centers have 6.5 to 15 units per acre, depending on the current density of that city. So that density would be closer to 15 in places like downtown San Francisco. It'd be closer to 6.5 or 8 in places like San Diego. In the second kind of class was what we call suburban nodes, and those have fewer than 6.5 units per acre. These are things like the Alameda Gateway Ferry Terminal, the Lockheed Martin Transit Center in Sunnyvale. So again, we're raising that a bit up to 6.5, but we're still being kind of neighborhood appropriate. And then the regional hubs are these are where there's major transit areas. So these are more than 15 units per acres. These are things like the Wilshire and Vermont Metro Station in Los Angeles that we'd expect to have more than 70 units developed per acre. These are more skyscrapers getting to true kind of density. So behind that number, it's not a boom, we're gonna make like I said, a Hong Kong style station in Bakersfield, but it's trying to be nuanced around what's the actual potential, and how do we also be really thoughtful around the existing transit agencies that exist, so we can use all of those assets as we think about housing potential.
Did you take into consideration growth, like transit growth, in any of your projections?
We didn't think about transit growth specifically, but we were hoping that density would encourage that. And so in some ways, it's kind of like chicken and the egg around, do you build it after you prove it, or do you prove it and then build it? I think the BART experiment that's going on right now is a really interesting way to measure that, with the ability that they have to kind of take ownership of the development that goes on in their station areas.
Just that Los Angeles has Measure M and Measure R, and it's billions of dollars worth of development along very dense corridors.
Mm-hmm.
And so there's a real, there's a policy objective and a policy direction of creating joint development projects in and around transit nodes. And originally it was just described within a quarter mile, but now they're expanding that to half a mile and even a mile in some places.
Ours is based off of half a mile.
Okay.
Or at least these estimates are.
Mm-hmm.
It's great that they're considering how to do that together. I will say one of the interesting things to think about too is how do we take advantage of TIFIA in a different way, given that, and the resourcing associated with it, particularly as you think about, does housing come first or does transit come first, and how can you make sure that everybody's sharing in that hopeful appreciation of asset base. Any other questions on this chart?
It's a little bit of a tangential question to this, but San Francisco, for example, there are thousands of units coming online, transit-oriented, vertical, dense appropriate density. In Trans Bay, the condos are $3 million condos, and so the affordability gap's still there. The other thing is who's buying those, and how many of them are actual residents, and how many are kind of outside money.
Yeah.
And so did you look at all at that in terms of the displacement of kind of pied-à-terre kind of investments and things like that?
Yeah, so we haven't put any kind of pricing around this, right? And because I think there is, if we knew the answer to that, I would have started my own real estate fund and have tried to figure this out. That said, what we did try to understand was this concept of ownership, and is there a large scale, again, and kind of in service to myth busting, large scale difference between ownership and rentals, and how do you think about that? We, especially in comparison to Vancouver, which when we published this report was going through some significant legislative work to understand foreign ownership in particular and its impact on the housing market. We did not see that bear out in terms of ownership and vacancy rates as a meaningful kind of chunk here as we think about, kind of putting vacant homes to work. Most of the stock that we could understand from publicly available information was actually being put to use in a meaningful way. And so that didn't seem to be something we should pursue. Not to say that there shouldn't be more work to actually continue to myth bust that, but that was our finding at the time.
Can I clarify one other thing on here? And that is that there's not a financial feasibility sort of overlay to this, right? So in other words, a lot of these places that are underutilized for various reasons, they're underutilized because it doesn't pencil to go higher in that particular place. So these bars are just assuming if you can make it pencil, here's sort of geographically, geometrically where you can fit the units, but not necessarily how to make them actually feasible.
Yes,
right?
that's true. And I guess two things to clarify. They're either, we didn't look into, hey, is this economically feasible for each particular parcel? The other thing is, do you have the will, irrespective of whether it's economically viable? And I think this gets to a bit of Irina's comments earlier around who actually has ownership, how do you decide how that's used, what are the incentives or disincentives that exist to push land towards full utilization? Yeah, good question. So big problem, but we have the capacity to solve it. And there's a couple of tools that we highlight as worth exploring as we thought about, what is it going to take to do a better job of meeting the demand that we have, given that the supply exists. And there's 3 categories that we highlighted. One is, how do you change the rules of the game for approving housing on high potential land? This is essentially, the takeaway here is to flip the paradigm from no to why not. What does it take to actually do that? How do you think about incentivizing local governments to approve already planned for housing? How do you accelerate land use approvals? One of the things that we tried to do is to take a developer back approach and say, if it's truly this question around economic feasibility, and we heard that from the developer core, both market and nonprofit, how do you get margin out of the process that you can actually say will help you get there, right? And so a lot of this had to do with predictability in the planning process. This has implications for CEQA. This has implications in terms of the ease and predictability of not only the process, but the people who are then helping run that process, how you think about the community planning process, all of that good stuff. There's a second big clunk, which is how can you unlock supply by cutting the cost and risk of producing housing? And while that first bucket that I just talked through was perhaps a bit more public sector, this second clunk is to say there's a variety of different tools available to us from both a public and a private perspective. Construction is the only industry in the last 70 years that has seen 0 productivity gains. It reached its productive height in 1968, also when OSHA came to bear. So there's good reason for that. But if you think about the impact of automation, you think about the impact of digitization, you think about the impact of modular and what that means now versus what it meant 20 to 25 years ago, it's the one industry that we haven't seen any type of productivity gains. So how do you put the onus on the construction sector to start experimenting with new ways of doing business, new ways of building, and still being able to be compliant with what's important to get right? How do you think about deploying modular construction? How do you think about deploying both of those things with a different product mix? So there's also, I think, an ability for the private sector and the nonprofit sector to think much more expansively around what does a good housing product look like. It doesn't necessarily need to be 3-bedroom, 2-bath, especially if you think about the kind of the kind of the barbells of our society, early professionals who are coming out of school, then those aging populations. Can we reimagine what that looks like? Can it come to a fundamentally different price point? How do we think about reducing housing operating costs, and then how do we align development impact fees with housing objectives? One of the other things to keep in mind is that when we did our research around development impact fees, what we found is that California on average is about 3x what other comparable states are, if we go back to that pure state.
So back to the rise in construction productivity. Give us what you said, something about 1968 and OSHA standards, and we haven't seen any new significant movement since then.
Right.
So does that deal with safety and?
There's a question around why haven't we seen the type of advances in productivity in construction that we've seen anywhere else?
And is that construction across the board, whether it's commercial, residential?
It is.
Okay.
It is. And so part of it's just the process. Our approach to building houses is pretty
Hasn't
darn
changed.
Exactly. So how do you think about, again, inspiring innovation or inspiring experimentation around doing something differently? How do we think about making sure that the trade-offs that we have around, and again, I want to be careful with what I'm saying here, but understanding that the trade-offs associated with the type of regulation, the type of inspections, the type of building codes that we're putting in place, and the impact that it has to actually do those things. Think about the difference of expectations that the nonprofit developer world has versus the for-profit or market rate developers. There's a higher standard in terms of building provisions that the nonprofit developer market has, right? That has a cost associated with it, that has trade-offs in terms of how many units come online. And so it's, I think the encouragement here is what's getting in the way of experimentation and innovation, and what can we do differently, or where can we start to kind of play around a little bit that allows us to see different outcomes in something that's really fundamental and scary when it comes to doing something differently.
4 times as many homes annually as we have been. Clearly at current productivity levels, that's 3 to 4 times the workforce engaged in that.
Yep.
I do know that modularization has the potential to have both safer working conditions and higher productivity. And it seems like we need to be having a labor supportive dialogue about how do we create those safer, more productive working conditions that leads to a larger skilled workforce. And I think there are entrenched forces that can't see this as a labor supportive dialogue. And that's what I think we need to say is we need more people building houses for ourselves in conditions that they can be more productive and realize the gains of that productivity in their paychecks, frankly. Right. So, I think there's a win there, but I think it's one that we've avoided or that has been a point of contention rather than an exploration. Let's put that out there.
There's also links to around modular to reduce housing operating costs. So if you think again about some of the work that's being done where there are now modular companies that are kind of cranking out RFID tagged walls in their manufacturing facilities. And that means that every pipe, even though the outlook or the cosmetics could look different, is actually in the same spot. So if you have a building superintendent, all of a sudden that person, he or she can get very good at understanding replacement parts, understanding maintenance, and it has a significant impact on housing costs too, or housing operating costs rather.
Field conditions often vary from the drawn conditions.
It's true.
We know that.
And then the final thing that I would just highlight.
Before you move, because I think Mayor Breed's proposal to do a modular plant in the Bay Area makes a lot of sense. I struggle with the idea of modular housing in Fresno because it means the job is going to be in Idaho, right? And if 50% of the cost of building a house is labor, and I take 50% of that and I move it out of the county that needs employment, it's kind of a tough thing. So I think yes, there has to be this conversation about how to make it work. Or it has to be like, we're really just going to focus on producing a bunch of housing regardless of where the employment comes from, kind of thing.
And those aren't polar opposites, they're considerations.
Right,
yeah.
right. No, I agree.
Yeah.
And then I was trying to look up the right term. I'm sorry, Ben is going to laugh at me. So is it tall tree, tall timber, tall tall wood construction? There's like this whole methodology they're testing in Portland, Oregon, and I know that Beneficial Bank and CAT has been really a big supporter of it, but I find that just really interesting to kind of also, that there are other construction methodologies that are out there that can be explored.
Right.
That I understand California has a hard time importing because it hasn't been done yet and trying to figure out how to make it fit within code or whatever the right way of saying
I think
it.
it's all part of the International Building Code now, it just hasn't been brought down into California code, but it would allow wood frame buildings to go up from 5 or 6 stories, 7 stories at best with podium to, I don't know, 16 stories or something.
I think
just
that's what
wood.
it is, something like that.
Which are also greener buildings because of the embedded carbon. You're capturing carbon into the wood, preserving the wood forever in a building rather than releasing it. So it's not carbon intensive to produce, it's the reverse. It's carbon negative.
It hasn't been carried down because of this tension.
So these are great examples of, gosh, if we could get a little experimentation and proof points, what could that actually mean for doing things differently, and then how quickly can we replicate where there are wins?
Do you have an answer why there hasn't been more productivity in construction?
There's a couple of reasons. One is that if you think about the capital intensity that it takes oftentimes to upgrade productivity, and you think about the boom or bust nature, it's hard for an individual home builder to actually invest in some new advancements. The other thing is if you think about the impact of digital and automation on the workforce, you also have issues around how long or how transient is your workforce, how able are you to appropriately train up and use and keep that workforce. And then the third is just this belief that like, hey, we're doing just fine just the way we are. And so if it ain't broke, don't fix it.
Who's saying
Who's
that?
saying that?
If you take a
My
look,
guys.
well, yeah, even if you think about the current state of play right now, especially being at full employment, the need to do something differently, or to say my job book is kind of lined up for the next 12 to 18 to 24 months. I'm good right now. Why would I need to invest in something right now when I seem to have a backlog and things are working?
I thought that the productivity measure was also a metric relative to units as opposed to residential per square footage. I'm gonna bring up a topic I brought up last time. So the other negative drag here is a cultural pattern of consumption that has increasingly over that same time period favored larger and larger and larger homes. So I think we're also, it just takes more labor hours to build a home because the home is bigger. And that's a function, I think, also of growing income inequality and wealth disparity. So you have folks who can't afford these larger homes and larger square footage, and then those who cannot.
I can't speak to that as much because the construction productivity elements are across the entire construction industry, and so I don't have this slice, and so I should also caveat my comments are not specific to residential, but across the spectrum of construction for commercial, industrial, et cetera. But that could absolutely be the case then.
And actually, on that same thread, if I can, I mean, I would be curious where in the 49th out of 50 measure, if you either ran that as per square footage residential, per capita, or homes per household. I think that would solve the Utah problem and probably still keep us at the bottom, but I'm just curious.
And then the homes in Texas are just bigger, so somehow they're gonna.
Yeah, that's.
The final thing, and then I will be, this is the last slide that I have, is around ensuring housing access. And this is around, you go back to the chart around low income or extremely low income, there is going to be a segment of the market that is not going to be served by nonprofit developers effectively, that is not going to be served by for-profit developers on their own dime. So how do you think about really effectively focusing public financing? How do you think about attracting new types of investors into affordable housing, patient capital, philanthropic dollars that need a different amount of return than a nonprofit developer or a for-profit or market rate developer would, in order to solve that issue, because it won't be solved in the marketplace.
One of the interesting things is looking at unions like the AFL-CIO and kind of the product that they have from, their proceeds or their investment dollars, and seeing if programmatically, there's an alignment between obtaining, their support for, prevailing wage jobs that we're building housing and having that investment happen within that same product. And does that help? Does that hurt? Can that be a pilot program that helps not only the job side, but also the supporting of affordable housing?
Exactly.
Yeah.
This is also, please.
Go.
So, and I'll let Preston weigh in this because he has some experience in this, but it sounds like more social housing or public housing may be needed at that very low to low housing, which would then deal with some of our labor issues because those are actually public housing owned by a public, which would be subject prevailing wage as more in line with a public works. And we had a visitor from the Netherlands that came in the other day, and he was talking about lessons learned in jury, and I sat with him and we said, well, don't take any lessons from California, unless you're taking what not to do. But I think they said some 30 to 40% of their housing is social housing.
It is 65% in Amsterdam, and the social housing organizations actually make a payment to the federal government every year because it's real estate that's performing and doing really well. So yeah, in the United States, percentage is 2% is social housing, right? So to me, yes, I'm a huge, Jovan and I are gonna disagree because I don't think home ownership is necessarily the way out of it. I think building up the social housing, not necessarily public housing, but nonprofit housing makes a lot of sense to me. So I kind of agree with you on that.
But from what I'm hearing, it needs to be a mechanism where you're not looking for the same type of a return, but that the return is investing right back into the housing so that you're keeping that housing, developing and operating that housing.
That's what we did with Bridge Housing earlier today, right? It's a great example of what we did. Yeah, so, and then I also think, again, I'm going back to, I'm sorry, Ben, you're making me think about this, right? It's like, what are the policies? What are the tax policies? I don't mean to touch a third rail, that are enabling the folks to be either in larger houses or overhoused, right? And the mortgage interest deduction does not lead to higher home ownership rates, and it really benefits households that make more than $200,000 a year. So why, and it's like $100 billion a year going into mortgage interest deduction. Why aren't we looking at that? Is it incentivizing larger homes that's then harming the overall economy?
That's not the problem.
Pardon me?
That's not the problem.
Well, the idea that someone can buy a bigger house and they're over buying because they get this, when you're a wealthy buyer, you get like more of the mortgage interest deduction than you get if you're a low-income buyer or if you're a renter. And then I think about in England, they had talked about doing like
NIMBY, brother.
they're talking about a bedroom tax, right? So saying if you have unused bedrooms, you should be paying a tax, right? And that's kind of an interesting concept. I mean, if we have people who need to right size into the units, then we should be thinking, not us, not Cali Church. Yeah.
The generic.
So if you think about what's the tax policies that we have in place that are incentivizing things, certain kind of behaviors. Bernie and AOC, they've given me freedom to speak up what I always thought, but I never said. So thank them.
Well, if you look at it right now, I mean, it's opening up a can of worms, right? Because the tax policy nowadays in the federal spectrum does not follow any sort of policy or any sort of policy philosophy, anything, right? It's not aligned. There's only, right now it doesn't matter in California because, there's no tax incentive to, well, I just don't want to get into the whole Trump thing, but never mind. So I'm just saying, policy's not aligned right now. Maybe we can have that conversation in 2020.
So comment on the final slide you showed, because I think the impact fees thing is just to underscore the fact that we just passed the CASA Act last year, which allows for municipalities to charge differential, to recalibrate the diffs to be maybe different to scale of building rather than simply by unit count. However, it was an opt-in law, and because of that, local municipalities have to do their own nexus studies and enormous amounts of time and effort to actually achieve that goal. versus something, like, what do you call, not an opt-in law, mandatory law, where you, the state, you don't need CEQA if it's mandated by the state. And so we have a case with CASA where we're trying locally to do that last thing, aligning development impact fees with housing objectives. And it's going to take a minimum of 1.5 years just to get the rate schedule into place.
Wow.
And that's a disincentive because we're
If I
a
could
disincentive.
add two just interesting things that we found as we were doing some municipal work. One is that we found even within development impact fees in a particular municipality, what it was estimated to cost a traffic light in one neighborhood versus what it was estimated to cost a traffic light in another neighborhood about 4 blocks away was a 1.5 to 2.5 times difference. So even rationalizing within municipalities' development impact fees is helpful. And then second thing is making sure that the development impact fees are actually being spent when they're supposed to be on the infrastructure that they were supposed to be spent on. So in each of this, we've helped a few nonprofits and a few municipalities think through this, and in each case, there were unused funds in these development impact accounts that hadn't been spent in a way that you would have anticipated. So that would be the other thing that I just encourage this body to think about.
And can I add on, because the municipal stuff fascinates me, is that the idea of by right construction, which we see as critical all the way down, the traffic division at the city was just mortified at the thought of removing things from discretionary review because they would lose their entire source of revenue for their CIP because of the exactions that they can do when they go through the discretionary process is a huge percentage of their CIP budgets, and that's just wrong. I mean, that's blatantly balancing housing or the budget on the back of housing.
Suzanne knows this because she saw it happen, but Ashley, when she was mayor in Fresno, rezoned the entire city, upzoned the whole city, did the general plan update, rezoned the entire city and upzoned it, and did by right all at the same time. It was
Got reelected?
And got reelected, and she did each of them on a single vote, right? Of the each action, right? It was pretty darn amazing. I think about the alignment of impact fees. I mean, I'm sorry, the last thing, and I'm kind of curious if this is statewide or not. But I see a lot of impact fees that happen to us on affordable housing that go to retired debts that are in affluent neighborhoods, where like the park impact fee doesn't go to benefit parks around the housing we're building, but goes to retire the debt in the affluent neighborhoods where home builders got assistance from the city, and now the affordable housing is paying for it. So is that what you mean by aligning the impact fees, or and I'm curious if that's statewide or is that just Fresno's kind of benefits it gives to private developers?
We were not that specific at that particular, with this particular statement, but it is to say, as you think about, again, kind of from a developer back perspective, the additional costs that you have, if reducing costs to get to an appropriate return to incent supply is something you want to make happen, where do you have control and do you understand the cost, implicit or explicit, across those steps that may inhibit how many folks are actually coming in and getting projects that pencil out? And so much of the municipal work that we've been doing is just to focus on what pieces do you control, how do you think about quantifying land holding costs, how do you think about these additional percentages or the risk and unpredictability that actually has a cost associated with it, how do you think about the impact of parking requirements and whether or not a homeowner is going to would want to spend $75,000 on a parking spot or say, you know what, I am comfortable walking 3 blocks to the shared parking garage if I know that my home purchase price is going to be $75,000 less off of $450,000 unit. That makes a difference. So that's what we meant, is just to make sure your outcomes and that you're choiceful around what you're intending with those dollars.
Ben, isn't HCD looking at a study or survey around developer impact fees? Do you want to say what it is that you guys are looking at?
Yeah, we are about maybe 6 months into a study of the state's development impact fees and working to develop some recommendations that we would bring back to the legislature this summer. Assemblyman Grayson has introduced a bill on this subject, which right now is sort of a placeholder. Yeah, 1483 is sort of a placeholder bill. But we have been deep on that, working closely with University of California, Berkeley Turner Center, who's our consultant on that project as well. And actually possibly going to be doing a sort of a public stakeholder engagement component in there as well to sort of fact check some of our findings before we take them to market. But I'll say, just some of the initial findings coming out of that are just so obvious. I mean, it's just an incredibly opaque process is one of the things that just hits you in the face, just how painful it's been in the process of doing this study to get the information about what the fees even are is very illustrative of the work that needs to happen in this area.
That's why one of those bills is just transparency.
Yeah.
Just list them on the internet.
I mean, even if you couldn't sort of put some guardrails on it or better linkages or nexuses, and there's going to be something in that space, just giving certainty to the marketplace so when you go in with a deal, kind of what it's going to cost would be a big benefit, I think, to get more investment happening, especially on more sort of marginal sites or high impact sites. Yep.
If I can add a question to that too, I mean, I'm curious, maybe Ben, your study covers this too, but to what degree you look at non-housing impact fees? Because I mean, we want transparency, and some of the impact fees really have a questionable nexus, but also at the local government level, and this is where our office interfaces with local government all the time, because of Prop 13 and because of just the economic distress of some local governments who are just still clawing out of the recession. The housing is a lose-lose situation for them to begin with because of the services that they have to provide, and commercial development is so much cheaper and brings in sales tax that housing doesn't. And so how do we balance that economic sort of disincentive for housing to begin with or without impact fees? And I think what some of them are trying to do is just scramble to tack on impact fees because they're losing money on housing, no matter what kind of housing and no matter where it is. So I think there's just, we have to look at impact fees broadly across all commercial sectors and not just the housing sector, I guess.
We're just looking at housing.
Sorry. It's the H in your name.
I think Suzanne brings a good point, because this is the issue that Preston was talking about from a public policy issue. There is fiscalization of land use is very real. And if we're going to talk about housing for all, we may have to have those very difficult conversations about how do we ensure that local government is able to pay for municipal services to support the housing that needs to be built. And if one of the financing mechanisms for our low and very low multifamily housing is the property tax exemption. Well, we all know that property taxes go to pay for municipal services. So when we blame local government for not approving affordable housing, but to the extent Prop 13 disincentivizes them from approving affordable housing, and to the extent we use property tax exemptions to pay for the affordable housing, then what is local government then using to pay for those municipal services? And I think we really do have to have those difficult conversations.
That's awesome. All right, we're approaching the time. Sharon, that was awesome. Thank you.
I know this said it's all proprietary. Are you able to share with us as board members or not?
Actually not.
Oh.
Our report is online and you can access all of the details. It's called Closing California Housing Gap. If you Google that plus McKinsey.
Closing California Housing Gap.
Closing California's Housing Gap. And I'm happy to send it to Melissa too, if it would be easy to share. Thank you.
Thank you, Shannon. Garth, why don't you come on up? Ladies and gentlemen, Garth Ryman, who's the Director of Housing Advocacy and Strategic Initiatives for the National Council of State Housing Agencies. I just met him last week. He introduced me last week, so I get to return the favor, Garth. He's been there since 1993. He helps NCSHA formulate and execute its policy on housing credit, housing bonds, housing finance reform, federal appropriations, and other affordable housing issues. He leads NCSHA's advocacy efforts. Mr. Ryman's previous experience includes working for the U.S. Senate House Subcommittee, National Association of Realtors, HUD, and the U.S. Office of Management and Budget. He's a graduate of some school, the Sage Hens Pomona College, I went to CMC, that's good to
saw
know,
that,
fellow
yeah.
Claremontian, and also Harvard's JFK School. Welcome, Garth, thank you.
Thank you, Garth. And if I could just say, Garth has been such a pleasure to work with, and understanding, the idea was to let the board have an understanding of what was going on in the state, a backdrop of perhaps some solutions, and then with the closing out with what's going on at a federal level so that we can all tie it together as we're looking forward and moving forward with the governor's proposed housing plans. So thank you again.
You're welcome. Thank you very much for including me in this workshop. As a native Californian and someone who lived in Sacramento when I worked for the California State Assembly staff for a couple of years and summer interned at what was then BTH. It's really fun to be back and quite an honor to be involved in this. I'm really impressed by just the the robustness of the discussion and the issues. And I think it's a sign of something that's reflected at the federal level, because I know how important affordable housing is to California. And we just hear from more and more congressional offices that we're visiting how important affordable housing is to many of the legislators in Washington. And I'll talk a little bit about whether that's likely to result in significant legislation or regulation anytime soon, but it certainly has elevated the discussion, maybe not to where we hope it will be, but they're just signs to how many people are wrestling with this, and this is just another example of it. So it's really just a pleasure to be part of this. So as Tia just said, I'll try to share my perspectives on the federal housing policy environment and how it may affect California generally and HFAs or Cal HFA specifically. I know many of you, probably all of you, are well informed in this area, so I hope I can add a little value, and please interrupt me with questions if you want me to go deeper or explain something or anything else. I'd be happy to do that at any point. So let's start with just a little discussion about the there we go, excuse me, overall environment. One of the most obvious factors is that the government is divided, both technically, since we have a Democratic House and a Republican Senate and administration, but also figuratively, as the partisan differences and congressional gridlock make getting things done, especially on a bipartisan traditional process basis, very difficult. We also have many new members in both the House and the Senate who entered Congress as a result of the last election. So just thinking that 10% of the Senate and almost a quarter of the House are new members, and it just reflects the fact that we need to spend some time trying to help make sure they understand housing and HFAs and put it into the context of much of the work that you're doing. Also, particularly in the House, these newcomers are very diverse, ethnically, politically, stylistically, and in how they approach their jobs, leadership, and constituencies. And so I think we've just seen, of course, on the front pages of papers, but also just in the kind of day-to-day conversations about legislation and regulation in Washington, how diverse and different a lot of the conversations are because of that. Some of the key committees have new leadership. Of course, that's almost automatic because of the change in party in the House. Many new members have become chairman, including Maxine Waters from California, of course. But also even in the Senate, we have a new Finance Committee chair because the previous chair retired. And while the same party is in leadership, we have a new chair. That's obviously very important for tax policy and housing policy also. Presidential campaigns gearing up adds a whole nother dimension and is another sign that we see of the greater interest in affordable housing. Many of the presidential campaigns, including Senator Harris's, are highlighting housing and resulting in new proposals for affordable housing, which are adding to the debate in the legislative and regulatory area as well. So going from the general to a little bit more specifics, I wanted to just list a set of legislative and regulatory issues, and then some that are really direct issues and then some that are indirect. This is just a long list, an example of both the salience of the issue and the variety that Congress is dealing with, some of them pretty detailed, some of them very general.
The list is just alphabetical, so I didn't attempt to prioritize it in any particular way at this point. That's not to say action is likely on all of these, or even some of them necessarily, because of the issues I just talked about.
I apologize, Garth, I have to get going.
That's okay, Preston. It's great to see you. Thank you very much. Excuse me. So I'll try to walk through these quickly and then pick a few out that I think may be a little bit more relevant, both because of the likelihood of action and their pertinence to HFAs and to states. But the Affordable Housing Credit Improvement Act is the bill that was introduced in the last session by Senator Cantwell in the Senate and by Representative Neal, who's now chairman of the House Ways and Means Committee in the House, to strengthen and improve the housing credit. FHA down payment assistance rules, very key to just a variety of HFA single-family programs. FHA, HFA risk-sharing securitization, very important for a number of HFA's multifamily programs. Fiscal year 2020 appropriations, pretty much every year Congress has to act on appropriations in one way or another, so I'll talk about funding for key affordable housing programs. Housing finance reform, always a major debate, but I think there's some wrinkles in it this year that I want to talk a little bit about. The Neighborhood Homes Investment Act is new legislation likely to be introduced very soon to try to promote new construction and rehabilitation, particularly where there's this appraisal gap, as people refer to it, that there are markets where you can't sell the single-family homes after you've built them or rehabilitated them because they don't demand a market price that is equal to the cost of construction. So some folks are working on a tax credit to try to make up that difference and promote more construction and rehabilitation. Performance-based contract administration procurement. I am particularly sad Preston had to leave before we addressed this. We were at a meeting together on this issue recently, but also very important. And rural housing continues to be a major discussion, and I see more and more policymakers talking about urban, suburban, and rural housing and not limiting their conversations to one or the other because they just understand the breadth of concerns and interests. So drilling down in another set of issues that are not as directly related to the traditional affordable housing agenda, but I think intersect with it in some really important ways. Again, alphabetical, but maybe even starting with climate change for reasons other than alphabetical. And we know the House is spending more time on that now, looking at it on its impact on a whole variety of areas. Community Reinvestment Act reform, this is an area that's much more likely to be regulatory rather than administrative. But even just recently, there were some interesting ideas about maybe trying to separate out the Community Reinvestment Act test for retail and community development, which would include housing areas. There have been some studies recently about the relative value to Community Reinvestment Act compliance of small business and affordable housing and community development lending. And I think it's affecting the discussion about how the regulations perhaps should be reformed and how that might really help bring more bank and private capital into affordable housing. And I think it's going to be hard for the federal regulators to agree on new regulation in that area, but I think they're looking at it closely. And while the OCC kind of started the discussion, it seems like the Federal Reserve Board and the FDIC are getting much more active, even just this week and last week, and whether that may result in them being able to get together on a proposal, I think is really interesting. Financial institutions, it's one of the main priorities of the House Financial Services and Senate Banking Committees this year. They're looking more at fintech, and I know for California there are a variety of firms that might affect directly. Flood insurance, in the last, again, week or two, we've seen hearings and new legislation in the flood insurance area trying to grapple with trying to make sure that is available in a way that supports continued housing development, that doesn't change pricing so much that it makes it more difficult to deal in potentially flood-impacted areas, but still responds to taxpayer risk issues. And then just a few others, infrastructure, opportunity zones, property assessed clean energy, PACE loans, CFPB just put out a notice to possibly change the regulatory directives in that area. Tax policy, and we always look at tax policy every year to see what kind of changes and legislation may be going through the process that may be an opportunity to include housing legislation. So while I'll talk much more specifically about the housing credit bill in a moment, I wanted to talk about tax policy a little bit more generally because we know Congress may try to pass some technical corrections to the tax reform bill. They may try to just amend that to change it. They're looking at extending expiring provisions or provisions that have expired, and these may all be opportunities to try to enact tax legislation in bills that could include some of the housing priorities that we're particularly interested in. So I just wanted to highlight that. Also, more interest in zoning reform, and I noticed much of the discussion today that touched on that, and Secretary Carson and other people throughout the Washington world have been talking more about how they may be able to create federal incentives or directives to try to encourage areas to promote more construction in states and localities by affecting some of the zoning decisions that they make. And I don't know whether that will ripen it. I know Ben and many other people have seen and been parts of administrations that have proposed these ideas in the past, and we haven't really enacted regulations and legislation that seem to have made a major difference yet, but it's always part of the discussion and perhaps could lead to changes at some point. So to try to talk a little bit about the context of what NCSHA is doing and some of the main issues for HFAs, I just thought I'd list NCSHA's 2019 priorities. I'll go through these pretty quickly, but it does set up some of the discussion, and that I'll go to in just a minute if you'll bear with me. But in a sense, kind of a top three, but certainly a major three are on the funding side, protecting and strengthening the state HFA role in the administration of federal resources and advocating on a strategic basis for other affordable housing programs. This priority for NCSHA is a little bit different than it's been in the past, thanks to Tia and some other folks that have been talking within the organization about it, which I think frees us up to be more involved in discussions about homeless assistance, disaster recovery, some other affordable housing funding that I know is important to California and HFAs and many others. To establish a central role for state HFAs in a reformed housing finance system to the extent it is reformed, trying to make sure that system makes capital available and affordable, including through the Housing Trust Fund and the Capital Magnet Fund. And then the Housing Credit Improvement Act, expanding the housing credit by at least 50% and implement improvements to it and multifamily bonds. As I said, I'll talk a little bit more about those in a moment. And I know many of you were just out in Washington talking about many of these priorities and looking at them, and I just wanted to say that parenthetically, both that our conference and in many of the visits you made separately, we really appreciated your involvement and know that it had a big impact. And I had a chance to see some of the materials that you all prepared for the congressional briefing, and I just thought that the briefing and the materials were very effective. So I just wanted to congratulate you all for that. I think that's terrific. Some of the other priorities that NCSHA is working on that I wanted to mention are pretty much covers the Neighborhood Homes Improvement Act that I just talked about, exploring the creation of a new federal resource to support the development and rehabilitation of affordable for-sale housing and implement improvements to mortgage revenue bonds and mortgage credit certificates. We have a list of ideas that we think could make those programs more effective. Supporting the utilization of the Opportunity Zone incentive to expand and preserve affordable housing. There's been a lot of discussion about affordable housing in opportunity zones and how to try to harness that incentive. There was just a hearing that the Internal Revenue Service had where NCSHA had an opportunity to testify to try to promote guidance and Internal Revenue Service directives that would improve the likelihood of using that for affordable housing and preservation. And we had an opportunity to go over and meet with the Secretary of Housing and Urban Development's senior staff, the special counsel that he's chairing, to look into ways to promote for federal involvement on opportunity zones. I think it's an interesting idea, and perhaps how to harness that incentive a little more.
Just to follow up on that, because I know the governor has mentioned that here, is it just the tax incentive, or is there any specific concepts coming out of how to use opportunity
Yeah,
zones?
in the legislation, it's just a tax incentive. I mean, many investors seem to think it really can be very powerful for entities that have a substantial amount of capital gains that they would then be able to protect. And then they would also be able to protect those capital gains in a way that would also protect the future return on that investment if they maintain the investment for a longer period of time. And what I think this White House Council that Secretary Carson is chairing is trying to do is trying to go to the next level and say, well, what are federal resources that the federal government can target or establish or bring to bear to focus even more investment in those opportunity zones and try to attract it both in the places and in the types that the federal agencies are particularly
Just
interested
as a
in.
plug, NCSA also has a list of all the folks who are financing in opportunity zones. It's on their website. So not just all listing of all the opportunity zones, but capital that's already looking to be placed.
Yeah, we're really proud of the directory that we've been developing, so thank you very much for mentioning it. And we've seen investors, media, other entities using our directory, and we thought that there were going to be a lot out there when we developed it, but folks are calling us to add to that directory all the time, and I think it's a powerful resource. Excuse me. And then we're also trying to come alongside some of the congressional and administration efforts to find ways to reduce burdensome regulations and streamline programs to make them more efficient for affordable housing. So let me try to dig into some of the specifics a little bit. I think that most people know this by now, but I just wanted to mention that just only several weeks ago, there was finally the final annual funding bill for HUD for fiscal year 2019. It didn't have quite as much for home as we had hoped, a little bit less than 2018, but still the second highest level since 2011, and I know that's important to state agencies using it for affordable housing. We think, and Congress thinks, enough funding for all voucher and project-based rental contract renewals. The 2019 contributions to the Housing Trust Fund, which is outside the normal appropriations process, but key to funding, are expected to be $245 million. That's just a little foreshadowing of what we're going to talk about in housing finance reform, is trying to make sure that the Federal Housing Finance Agency actually makes that money available to HUD, and HUD actually gets it to California and the other states that want to use it. And then I just added, because I know California has been one of the states particularly interested in and active in the Section 811 Housing for People with Disabilities program. And we think that's enough to renew existing vouchers and to provide some additional money to support new construction or new project rental assistance contracts. And we're actively involved in HUD to trying to make sure that HUD does that in a way that gives states the maximum amount of flexibility to use those funds for the 811 program. So now we're entering into the process of Congress looking at funding for fiscal year 2020. And one of the overall backdrops for that is that the Budget Control Act set annual spending targets for many years. The last couple of years, those have been, in effect, raised by a deal that Congress made to allow a little bit more spending than would have been allowed under the Budget Control Act. That deal expired as of the last fiscal year, so going into fiscal year 2020, unless there's a new deal like that, Congress has much lower limits that it has to work within when it provides appropriations, and that could involve budget cuts of up to 10% from what current funding levels are. I think people expect some kind of deal to increase those, but how and when that will happen is probably going to be a very difficult discussion. And in the president's budget request, which has come out over the last couple of weeks, some details last week and some details even just today, it looks like the president is saying that he wants to stick as close to those funding levels for domestic programs as possible, but put more money into defense programs, which I think creates some of the dynamic of this negotiation about what to do, and is part of what Congress is doing now to begin work on the fiscal year 2020 spending bills. There have already been some hearings on those programs, and we had an opportunity to have the director of the North Carolina Housing Finance Agency testified at a House HUD subcommittee hearing, and I think they're very interested in trying to provide adequate funding for housing, but they have to work within this overall limit that makes it very difficult. And one of the other items that makes it complicated is the fact that the administration has proposed to severely cut most housing programs, to eliminate CDBG and home and several other programs, choice neighborhoods and others, and to reduce or really limit the increases for other programs below what many people think is necessary for current services. So I think we expect Congress to try to fund those programs much closer to current level spending, but it's a difficult discussion that they'll be having, that these budget releases and appropriations hearings have really just started. So moving from funding to one of the other major areas, I did want to talk a little bit about housing finance reform, because I think there is a slightly different dynamic this year, largely because there is potentially, well, there is a new Federal Housing Finance Agency director. Right now we have an acting director, Joseph Otting, but Mark Calabria has been nominated and approved by the Senate Banking Committee, but not by the full Senate. I think that's pretty likely over the next several weeks. And there is some observations that he's likely to change some of the rules that Fannie Mae and Freddie Mac operate under, that he may change pricing, he may change affordable housing goals, he may change some of what is eligible for some of that GSE financing. I think people think more likely that it's likely to be more incremental rather than dramatic, especially going into a presidential campaign and dealing with the negotiations with the Treasury Department that are very important. But there's also the idea that he has pretty strong feelings about the role of Fannie Mae and Freddie Mac, and could very well make changes that might affect the ability of HFAs and all lenders and all partners to take advantage of some of those programs and products that the GSEs offer, and also whether FHFA will continue allowing the transfer of the Housing Trust Fund money from the GSEs to the HUD for the Housing Trust Fund and the Capital Magna Fund, because there were many years when the Federal Housing Finance Agency said that they felt that the GSEs were in too precarious a financial position, they were undercapitalized, and they should not be sending that money to HUD and Treasury for those programs. And we know that FHFA and Mark Calabria are likely to be very concerned about building capital and the capital ratio. So it looks like in his hearing and other discussions, he's said that he supports these programs and intends to continue with them. But as is often the case in these hearings, the language has been vague enough that we don't think of any of them as ironclad promises. And so we think it's very important to continue the discussion about it. And that will also take place in a more general congressional discussion about housing finance reform. Senate Banking Committee Chairman has already released a new draft. He's just in the process of announcing this week, holding some additional hearings early next week to look at housing finance reform. And I think both the House and the Senate very much want to be involved in the discussion. Chairman Waters, for example, has already sent FHFA some letters saying we want to make sure that you work with us and don't get too far ahead of Congress in the housing finance reform area. But what happens in housing finance reform and how that discussion goes may have a big impact on the availability of those programs and funds for affordable housing. Again, I wanted to mention the Affordable Housing Credit Improvement Act. It's just the key program to generating federal assistance for multifamily construction. It's probably responsible for well over half of all affordable multifamily construction throughout the country. And we are looking for a way to expand it and strengthen it, including tying into some of the priorities I heard you talking about earlier today to try to change the rate on the 4% bond finance deals to allow more capital to come into those deals, to make changes to make it easier to do veterans and other specially targeted housing because of some confusion that's come up with how to use that with the housing credit, and then make a whole series of changes to just expand the ability of the program to meet its goals and even go beyond what it's doing now. I also wanted to talk a little bit about the HFA Multifamily Loan Risk Sharing Program, because we've really partnered with TIA and California HFA and many other HFAs in doing everything that we could to extend and preserve the Federal Financing Bank initiative. And unfortunately, we weren't successful in that, and that's terminated now. We hope just in hiatus, but it seems like it's going to be very difficult to reinstate it. But we do really want to spend as much time as we can on promoting the ability and legislation to expand the way HFAs can use the traditional risk-sharing program. In other words, not with the Federal Financing Bank, but through other capital outlets, other investors, Fannie Mae, Freddie Mac, banks, pension firms, insurance companies, others. And we think that one key to that is promoting a legislative change that would allow Ginnie Mae to securitize those risk-sharing loans, basically to buy them or to put capital up for them to keep that money revolving. And we think that Chairman Waters and some other congressional offices are very interested in pursuing that. We know that the Mortgage Bankers Association has some concerns, and there may just be the inertia of the congressional process to get through, but we think it would be valuable for the program and want to look at that and other ways to try to promote more use of the risk-sharing program for states to have that outlet for multifamily financing. There's a couple more things to deal with a little bit more briefly. As I mentioned, HUD plans to issue a new procurement for the Performance-Based Contract Administration Program. It's a valuable source of both the ability to manage the assets and the Section 8 properties within states to make sure they're serving the interests of the tenants and the communities and the federal public purpose, but also to generate significant revenue for agencies that are implementing it. We expect HUD to release a new proposal soon. This has been kind of the watched pot that never boils, and we've been thinking it's going to happen soon for quite a while now, but we are looking for some proposals soon, both to issue new bids for new entities participating in the program, but also to potentially change the existing contracts to try to save money under the appropriators directive. And we have some priorities here to make sure it goes through public housing entities and allows states to work throughout and in their states, and to make sure PBCAs can do all of the work and not just kind of contract little pieces of it in a way where it's broken up and much harder to put together. So that's a list of issues that I wanted to talk about. I know that you're probably the last group I need to remind on this, but certainly, a major backdrop that I wanted to raise being here in California is just, the value we see in working for the congressional delegation from California. There are, so many key legislators that I've just listed here, and we enjoy both our relationships with them, but especially working through the HFA as it works with them to try to leverage that influence as much as we can to enact many of these priorities. So with that, I'll be done with my prepared remarks and happy to answer any questions or respond to any comments that you might have.
Garth, can you put up the list of key California delegation members? So just so that you all know, we did meet with staff from Feinstein Harris's office and Waters' office. We are going to try to reach Kevin McCarty in maybe his district office, Barbara Lee in her district office, and Brad Sherman. And we did get a chance to speak with Mike Thompson's office, so, and many other visits that we made, but the speaker's office, of course. We did had an excellent meet. And both Katie Porter and Katie Hill.
A little bit of an oversight there, excuse me. That's right.
Yes, we did get a chance to do that. So working with NCSHA, we were able, and the diligence of staff, we were able to have some very good meetings on the Hill. I think when talking to the Novogradac firm on the importance of expanding the tax credits, the extra value in bringing to the tax credits, which we did make sure we told the California delegation, is conservatively another 500 to 600 million in resources that we could be bringing to the state of California by adding that extra value to the 4% tax credits. And so, thank you, and thank you for all of the work NCSHA has done. It's been an excellent partnership.
And yeah, it's so important to talk about the speaker, but I also don't want to allow focusing on this list to, in a sense, diminish the importance of contacting a lot of the other offices, because one of the things that we're going to be doing to try to promote this Housing Credit Improvement Act and other legislation is to get as many co-signers to co-sponsor legislation or to sign on to letters supporting some of these priorities. And I think that many of the new members are great examples of people that may want to find an issue where they can show that they're engaged and that they're working on something and they're committed to certain priorities. And co-sponsoring some of this legislation is a great way for them to do that. And we're definitely hopeful that we can sign as many people up as co-sponsors and on those sign-on letters as possible.
Just so they don't think it's all rosy, what's Grassley's problem from chair of, what's it been, chair of?
He was the chair of the Senate Judiciary Committee.
But he doesn't like tax credits.
And now he's the chairman of the Senate Finance Committee. And it appears he has some questions about the housing credit. I guess that's the way I'd want to put it right now. When he was the chairman of the Judiciary Committee, he's a longtime member of the Senate Finance Committee. He was actually the senior Republican for a while. So he wasn't really stepping out of his areas of jurisdiction to do this. But he asked the Government Accountability Office to do a series of examinations of the housing credit. So over the last few years, the GAO has released reports on state administration of the credit, on the role of syndicators, on other aspects, on development costs, and other aspects of the credit. And we don't know if he's going to pick up any of those reports and possibly use those as the basis for any kind of action or hearings or comments on the housing credit program. We've talked to several people in his staff about it, and it seems like it's more oriented towards trying to make sure that the Internal Revenue Service is administering the program as effectively as possible. He seems to have more concerns with the IRS and its administration than the program and its attempts. Going significantly back, unfortunately longer ago than we'd like, he was a supporter of some key housing credit legislation in the past. He hasn't co-sponsored the most recent legislation, so we do have some anxiety that he's not going to be as strong a supporter as Chairman Hatch was in the last session of Congress, but we're hopeful that we'll be able to help him understand how important it is and that he won't be an opponent in any way.
The trip out here. Good to get all this intelligence, and thank you for all the work that you do at NCSHA and have been doing for so many years. You really are an anchor and inspiration for all of us in terms of trying to keep things going in Washington. So the only observation is I think sometimes over the years I sometimes felt like NCSHA had a little bit of a rap of really being a little parochial in terms of really just fighting very narrowly for the interests of state housing finance agencies, and sometimes folks would sort of feel like I'd hear this from other folks out there that, well, NCSHA really just wants the HFAs to capture a larger set of the market share in the lending business, or very narrowly focusing on tax credit provisions that maybe didn't reflect the greatest, public benefit or value. And so I like where what you've laid out here, I think, is really helpful in terms of sort of a broader, more holistic view of what are the housing problems that are facing the states, and how can NCSHA bring that together. So whether it's the work on disaster recovery or beginning to think on zoning issues, I know it starts to feel like a lot and expands your universe of things you're trying to keep your pulse on, but I think it positions NCSHA to be much more effective in driving the agenda in Washington and helping us take advantage of these opportunities as they come up. So it's an awesome list of stuff that you're trying to keep all in your head. I know you can do it though, so keep at it, and thank you again for coming out here.
Well, thank you very much, and I think that we have seen how important the linkages between HFAs and so many of the other partners, and how many how important all these programs are to the success of HFAs. And just a quick comment on our leadership. Tia was just elected president, now chair last fall, and almost exactly a year ago, we had a new executive director, Stockton Williams, and I think both of them have really been intent on pushing this in this direction, trying to be valuable to affordable housing in general while being very helpful to HFA specifically and promoting partnerships and alliances as broadly as we can. And so I'm glad it looks like that's what we're doing. That's what we want to do, and we'll try to keep it up.
First of all, thank you, Garth, for coming here today, and thank you for being willing to throw yourself into the buzzsaw of Washington politics, because I would not, I'm happy here in California, the California Republic here. A couple of comments on things. I mean, opportunity zones are an issue that's a little contentious in a lot of our underserved communities because there isn't any local control, being a federal tax benefit. We're looking at ways either locally through ministerial approvals, or if there's legislative relief that can change to give a little more local control over the nature of opportunity zone projects. They have not always been the most community beneficial. And so I think it's important to distinguish between the nature, the types of investments that are made. And I would hope you'd have your antenna up for things that are really just investor benefits versus things that are really community benefits. And I need to school myself on that differential myself, but I just want to raise the issue because it's been in conversations I've had with other folks. The trust fund, I mean, that's a classic case where it's like, when you look at the anemic level of federal funding, was it 240 million for the Housing Trust Fund?
Yeah, 245.
245, so California, if we get 10%, it's 24 million. If we get our 8% in San Diego, we've got, 1/8 of a permanent supportive housing project. That just speaks to the need for change at a national level. I mean, but again, that's why I bless you for being willing to stand there and hold the line against even having that reduced or sliding backwards. My final word would just be that if there's a need for any of the San Diego delegation, 4 of the 5 I can get to pretty easily. Mr. Hunter doesn't return my calls. Come on. Well, I haven't called him yet, so. Yeah, it's the tie and the hat that do that. In any case, I'd be happy to do any outreach if we're looking for co-sponsors, especially Representatives Davis, Peters, Vargas are ones that I can get to most easily, and would happy to make our case as need be. And thank you again for coming here and for your work.
You're very welcome. And just to comment really quickly on the opportunity zones and Housing Trust Fund, I think that your concerns are very well placed and important to us too. I do think that because of the way the assessment fee was set on the GSEs, and then the fact that they had a little bit less activity last year that generated the fees than the year before, it's one of the issues that we've seen, and one of the reasons why in the discussion about housing finance reform, we and many others want to make sure that assessment fee for the Housing Trust Fund goes significantly up and is applied much more generally to a wider variety of the GSE's activity. And on opportunity zones, I think that a number of the concerns that you raised are shared by many communities, and I think that they are looking into their permitting and administrative and other tools that they have to channel investments. But at the federal level, and we're trying to make sure that the IRS is aware of some of the concerns about gentrification or displacement or other concerns. And our testimony at the Internal Revenue Service hearing tried to emphasize some of those, and also tried to make sure that there's enough transparency and reporting requirements that communities can see very clearly and very generally what is happening in the opportunity zones, to then create an environment where maybe the communities can react or the federal government can even react, but to make sure we really know what's going on, because there's this period right now where I don't think we know, so it's very easy to go back and forth between fear that it's going to be a really negative influence and kind of hyper optimism that it's going to be a panacea, and so we need information to figure out what's really happening.
I'm all about data-driven policy. Yeah. Thank you.
From the Governor's Office of Planning and Research, and Governor's Office and GOBIZ, the Governor's Office of Business and Economic Development, have kind of an ad hoc working group on opportunity zones to help figure out exactly these questions. How do we as the state help to foster the investments that we want to see in affordable housing and in other community development realms? And it would be great to maybe have just an informal channel to what you're seeing and hearing at the state level, so that we might connect with our counterparts in other states to learn best practices there. Because I think, like, similar to what you just said about this dichotomy between, is it the worst thing ever or the best thing ever? I think there's also a dichotomy of, you know, we want everything just for our state, and but we want to partner with other states because we want to get it right at a national level, regardless of sort of where these things happen. So if there's any way that we can be of help to other states or vice versa, if you're hearing things, best practices coming out of other state levels, whether it's HFAs or otherwise, we would be really grateful to know those things and to be able to connect with our counterparts.
Yeah, that's great. I would love to provide Tia as much information as we have to try to get it through to you. And we do have a special task force set up on opportunity zones that several states are participating in. And so as we get more information through that, and I mean, the directory might even be helpful because some of those funds are state or regional specific, some are more general. But as we start to learn more about state policies, we're putting some of those up on our website and trying to collect some information. So I'd be happy to try to share that to facilitate that kind of information.
That would be great. And I'll just say too, I mean, there's a lot of people in a lot of states working on this, but especially the HFA practitioners who have an eye towards affordable housing and really, you know, solidifying community impact in particular would be great partners for us. So thank you.
Good.
And thanks, Tia, for being that channel. I think I just volunteered you.
On the ad hoc committee meeting, and like Garth said, we do have a HFA task force that our task force has been meeting pretty regularly on opportunity zones. As you all may know, the California's federal tax related to capital gains does not comply with federal law. So one of the things that the state treasurer and the governor have been out getting more information about is whether or not, should that law comply with federal law, could that be for projects that are affordable housing projects or infrastructure related to affordable housing projects, so that when you invest in those type of projects, then you were able to take advantage of some of these things that were offered by opportunity zones to get a closer tie to affordable housing and the infrastructure that supports affordable housing. So as we continue to have these best practices and the best practices are fleshed out, we'll make sure we share those with the ad hoc group. And I think Mr. Russell had a question.
So Community Reinvestment Act, that's one of the big elephants in the room as far as banks' behavior, tax credit markets, things like that. Do you see, can you elaborate on anything that you see out there going on with regards to CRA reform? I won't call it reform, change.
Yeah, so on change, not more on just what's happening under CRA right now.
Right.
Yeah. Well, I think that
Aren't they trying to change, currently trying to
they
change?
are. They are.
That's what you're talking about, right?
The Office of the Comptroller of Currency issued a advance notice of proposed rulemaking last year, which asked a whole series of questions focusing on a few issues. Really, is CRA keeping up to date with changes in the banking industry? In other words, are there entities that are obviously financial institutions and getting benefit from their relationship with the federal government that are not coming under Community Reinvestment Act in any way whatsoever? And another major area is, do assessment areas really make sense? Is there a different way of looking at assessment areas so we try to come more up to date with the fact that more banking activity is being undertaken through the internet or remotely or in other ways? So a branch headquarters-based geography still makes sense, or whether there's a way to try to accommodate the way assessment areas are looked at. And then just a number of changes, a number of questions that relate more to, are there other ways to improve this? Can we provide more certainty in the evaluation? Can we try to roll up evaluation scores in a way where we can either create one overall score? That was a very unpopular idea, but maybe more generally, is there a way to change the scoring to give banks more predictability and give people the ability to understand what a bank's performance level is by kind of fewer quantitative metrics. And they've received, I'm sure, thousands of comments on that and are going through it. The reason I mentioned in my other remarks that recently the Federal Reserve Board and the FDIC have gotten a little bit more involved in the discussion, the reason that's very important is because normally for CRA regulations to be issued, those three would have to work together. So the fact that the OCC went out on its own, some people perceived as a sign that maybe they're not aligned or it'll be more difficult to get them aligned. I think it's fair to make the argument that that was really more just because the OCC was up and running and had gone through its transition and wanted to get going, whereas the other entities were still undergoing more post-election transition, and now they're starting to enter the discussion and would like to see all of the agencies aligned. But I think those are still the core issues of what they're going to be looking at. I think that there's going to be a great difficulty in harmonizing everybody's comments and views to come up with a consensus. Whether those three agencies will feel like they are sure enough of what they want to do and have enough of a consensus that they feel comfortable going forward with it is really everybody's $64,000 question. And I can't really predict that, but I think that there will be, just more and more discussion about how to make the Community Reinvestment Act more effective, and hopefully that'll move the debate forward to a place where they may feel like they could issue something.
Super. Well, thank you for your wealth of background and information here today.
No, you're
Appreciate
very
it.
welcome.
The financial institutions are asking for with the CRA is timely responsiveness. That has been one of the greatest challenges, is that the financial institutions do not understand or do not get feedback until they're more than halfway through the assessment period.
What counts?
What counts? So they don't know what counts and what doesn't count until it's too late to make any changes. But I think the biggest thing that would help in terms of housing development is a change in the assessment area and how those things get accounted for. We all know that most of us bank on our cell phones right now at all economic levels. That's been proven time and time again. And so to judge based on where a branch is located is slightly archaic, and it just doesn't make any sense anymore. So that, between those two, timely responses and attacking the issues around the assessment area, those are the two primary things that those of us who are in the financial institution are looking for them to respond. And I agree with you, OCC did start it, but now we are starting to see the Federal Reserve Bank and the FDIC as part of the conversation, which is an absolute necessity. Because what you do not want to have is OCC thinking one way and then FRB doing something else, and FDIC is looking at it whole. There's got to be continuity across the board with those regulatory agencies.
Yeah. We even thought that issue of assessment areas and the timeliness of evaluation and knowing what the scores were even related, because we're very concerned that so much housing credit investment goes to a few assessment areas that then it almost kind of starves some of the areas outside of assessment areas. So what we wrote in our comments is, as long as a bank knows that they met their assessment area and their overall CRA goals in 1 year, then after that, when they have a satisfactory rating to rest on, let them move out into a broader area of assessment areas, try to spread that capital out more efficiently, and then that would be a way to kind of try to harmonize those concerns. But we don't know what they're going to do, but we're trying to do what we can.
Awesome. That's great.
Yeah, one of the programs that you talked about was really interesting, and I think ties back to what we're trying to do in the single-family side. It's the Neighborhood Homes Investment Act.
Yes.
So I know that in the Bay Area, there's such a huge discrepancy between the cost of building single-family homes and what you can actually sell for to an affordable household. Like in Richmond, they have a set aside. for affordable households, where they have to set aside about, 15 to 20% of the of the units sold to folks at 80% or below. But, those folks can't really afford to pay the prices of what it costs to build out in San Francisco or out in the area. So it would be great to I don't know whether Tim can do it or whether, our ledge folks can do it. But if we can get an update on that program, that would be very, very helpful. And I think it align with kind of the program that Tim's trying to do, which is more about doing a forward commitment to developers to give soft seconds or rate locks to home buyers. So
I'll make
just
sure
keep
we
aligned.
provide the information to the HFAs on the legislation as soon as it's introduced, things like that. And it is intended to be a program that's targeted by income and purchase levels to try to make sure it is, targeting the benefit to, it sounds like the kinds of communities that you might be talking about, as well as potentially more broadly.
Yeah, thank you.
Well, thank you, sir.
You're very welcome. Thank
Appreciate
you
you
very
coming
much.
out and helping us out. Anyone from the public want to say anything? Any final comments from board members? We all listened and talked out. Well, I certainly want to thank staff and thank all of you for spending all day here. And Anna Maria, thanks to your kids. They've been awesome through the whole day. They've listened.
So impressed.
Right? I mean,
Yes.
my kids couldn't sit like that all day. And they're older.
Were we able to get a tour? Okay.
We're gonna get back
Okay.
to you.
Very good, very good.
Then with that, no other comments, we stand adjourned.
Thank you.